Hello everyone, today is Friday, March 3rd of 2020, and today we have a very special event. This is a free event. This is a contribution to our community from all of us. As we are sitting in the lockdown, I'm just here in San Francisco doing exactly that. This is my third week, and I know that quite a lot of you are doing the same thing, that we're doing what we're supposed to do. There is nothing else for us to do but just, get together, talk about the markets, figure this thing out, and just listen uh, to expert opinions about how they viewed this bear market, what is their current view, what are their, projections, ideas about how market can unfold from here. This has been a very interesting time, but at this interesting time, we feel that our Wyckoff Nation, our community is very strong. And Bruce and I, we've talked about this multiple times this week, and we're just amazed with all of you, contacting us, sending us your charts, coming to the classes, sharing your opinions, asking questions. And it was appropriate for us, to create an event like this, where everybody can come and just share their opinions. As speakers, going to present, we're going to have a chance to ask questions. So please, as the presentation goes on, into the end of it, make sure that you post your questions in the question box. Each presenter will have about 30 minutes or so, and then we'll go into the Q&A. I'll ask the first initial couple of questions as the lead on, and then we'll go to your questions. All of the sessions will be recorded, so please don't worry if for some reason you have to go, that's fine. You could catch up the video later on our Wyckoff Trading Method YouTube channel. We'll tweet it out, we'll send emails, so you will have this recording hopefully by the evening, our Pacific time. And what a lineup of speakers that we have today. I'm just looking at these four gentlemen, and I just can't say enough about all of them. And it is my pleasure to introduce my friend, my teacher, my mentor, as the first speaker, Bruce Fraser. I've met Bruce back in, I believe, 1996 when I came to Golden Gate University, and I first met Hank, and Hank literally in 5 minutes sold me on Wyckoff methodology. I signed up for the Wyckoff class, and Bruce was co-teaching this class, I believe. And that's how my relationship started with Bruce. Then later on, I had a chance to go through quite a few mentoring sessions with Bruce, not necessarily on the methodology itself, but on some other, personal things. And that was extremely helpful. And then later on, we started collaborating under the Wyckoff Analytics umbrella at the TSASF, local technical analysis organization. And that collaboration led to many wonderful products that we've created together. And Bruce is a well-known Wyckoffian. He is producing so much content on the weekly basis. If you are not familiar with his work, I would say that, you not only you have to go and read his blogs, Wyckoff Power Charting, you have to deliberately put them in such order of knowledge, because there is so much stuff there in his blogs. He basically wrote a book online, and it reads as a book, and it has specific sequence of thought there. On the top of this, Bruce is producing power charting video episodes at stock charts, which are also extremely popular. Together with Bruce, we conduct Wyckoff Market Discussion series, which comes out weekly on Wednesdays at 3 p.m. Pacific. So check that out as well. And I probably could talk a lot about Bruce. I mean, we've been creating stuff together for quite some time. And I just, with all of my heart, Bruce, I welcome you. I'm very happy that you could make it. I'm very happy that you're excited about this event. We can't definitely go on without your presence at such event. It's just great to have you.
Well, thank you. It's, Roman, I'm going a little stir crazy. And so this was a really good idea because I've been so busy putting together this presentation, I haven't had time to continue to go stir crazy. So
All right.
I'm thrilled to be here. And Roman, you've totally enriched my life. I've had so much fun collaborating with you. I love our Wednesdays with our Wyckoff community where we do Wyckoff market discussions. And I just can't say enough about that. And so with that, Roman, I have way more stuff than I have time to do this.
Great. Let's go for it. Everything is kind of improvised today. I mean, we literally put everything in a couple of days, so we're gonna see how it's gonna go.
Now, you can see my screen okay?
Yes.
Terrific. So I sort of feel like since the beginning of the year, we've landed in Oz. We're in a parallel universe. Something's very different that all of a sudden it's like our house is like come down and crash landed in this strange land. And we're like Dorothy and Toto. And Toto, I have a feeling we're not in Kansas anymore. And so this is the thing about Oz is that Oz is a very different world. It's got lions, tigers, and bears, flying monkeys, wicked witches. Even the wizard was kind of a bad guy. And so there's all of these things, these, sort of new, threats that are hovering about in this new world that we live in. And so what I'd like to do is I would like to bring in Dr. Wyckoff and using this wonderful methodology, see if we can't find a way to get on the path on the yellow brick road and find our way back to Kansas. And so with that, let's get started. So, and Roman, if you have you want to jump in. Roman and I go back and forth on our Wednesday sessions all the time. And I have some very cool slide at the end I want to show. I'd love to get Roman's feedback on that one. But anytime you want to jump in, please do so. And sure. I'm putting my timer on because I want to make sure I stay on time because I want to hear these other speakers. So here is the classic business cycle, which is the dotted line with the stock market superimposed. You can see the stock market precedes the business cycle. It anticipates, looks ahead, discounts the future. So we can see here that we've gone through some kind of we've been in markup for a very long time. We've gone through some kind of a distribution phase here, and we've started to turn down. And the thing about that, and this is probably the most important thing, is currently we're in the markdown phase. And the markdown phase has a very clear essential nature to it, qualities to it, which are tremendous volatility, the huge amounts of volume, distribution, market falls very quickly. It's scary as it can be. This is where the flying monkeys are. And so we can see from this discounting mechanism that the stock market is telling us that there's going to be top line, headline news about the business cycle that is going to get worse and worse. And we know that going in. Now, we want to think about that a certain way from a Wyckoffian perspective, because Professor Wyckoff was very much aware of these relationships 100 years ago, and they really haven't changed. So let's get on, and I want to show you some trend lines, because I think one of the coolest things that Wyckoff does is trend line analysis. And I'm going to show you trend lines on different time frames, which blow my mind. And here we're looking at yearly bars. So these yearly bars, this is 1942. We always try to find two anchor points that are adjacent to each other. So on this yearly chart analysis, 1942, the depths of World War II, 1974, which was the worst decline in the stock market since the Great Depression. And so these are the two adjacent lows. And you can see here that back in 2009, we got very close to touching it again, didn't quite get there. And so I originally showed this chart at the end of 2019 and showed this 2019 bar right here. I guess I could get the highlighter going. And you can see, let's pick a good color here, that we went up and touched this area right here, which is the overbought line at the end, the very end of 2019. We know from the beginning of 2019 to the end, it was just basically an upward trending market. It went up, it touched the overbought line. And at that time I said, you know, I think we might be able to get through the top of this line at some point, but I think we're going to have to spend some time doing some work up here before we can begin to go up through it again. Well, here we are at the end of March, and this is 2020 so far. And you can see this is a substantially large bar. This bar in 2008 was bigger. This bar in 2002 was about the same size. Here back in 74, about the same size. And then we have 29 to 32, which was in its own way quite an event in itself. So here we are. How do we deal with this? What do we do from here? But I want to show you these trend lines because they are, I think, magnificent, spectacular trend lines, and look at how we touched that right at the end of the year and then reacted off of it. Okay, and so if you see these notes down here at the bottom, these are, in this case, power charting videos. You can go reference these. Actually, I showed this chart, I think, on December 6th or 5th also. But anyway, now let's go to the weekly time frame. I can't spend a lot of time on these, but here, this is 2016. Here's the anchor points in 2016. You take the intervening high, you draw a parallel. I always draw the parallel as a dotted line, and the solid line is the main trend line. So you can see here, look at this beautiful throw over, huge buying climax at the beginning of 2018. And so this was a really important event, threw over and then immediately collapsed back down to the bottom of the channel, tested again, and then went up, but could not rally in this upthrust of the buying climax back up to the overbought line, which in and of itself was a sign of weakness. And then a failure from October of 2018 down to December of 2018, you can see this just big collapse that takes, in this case, the S&P out of its upward trending channel and has what I'm calling here a shakeout. I've drawn a parallel line here off of this, only from the notion that if we continue to bounce here, and we'll talk more about this later, I will be looking to see whether or not, and I want you to just make a note of this for yourself, is whether or not this becomes a target zone around 2850 S&P for a rally phase, which also would probably put it in the range of the long-term, in this case, 39-week moving average. So they sort of coincide here. I'm not necessarily predicting that, but I'm paying attention to it. Now, look at the throw over and the overbought condition as we came into the end of 2019, 2020. Throw over of this very important demand line, but from underneath, which is a position of weakness. And you can see here just this, which we just all experienced, this amazing cascading decline that we've just been through, and off of these two peaks, January and February. And so moving on, this, I'm going to come back to this later, but I want to show you, this is the daily view. And so I just want to show you how all these trend lines just all coincided. It's like poetry, the way that they all just sort of came together at this essential moment at the beginning of 2020. And you can see here that I've shown this chart back in these prior videos, but here, and you can go back to the beginning of 2019, and I do this point and figure analysis here. And I also did this in blogs, so you can go back and look at these early blogs in 2019. I think around January 10th, I wrote a blog that with these counts. But look at this. This count at the time, and everybody thought I was crazy to even publish this, when the Dow was around a count line of 22,500, I had a count that went all the way up to 29,254. And at that time, I don't think anybody thought that was even remotely possible. And of course, this is the year 2019. Then there was a reaccumulation structure that formed. This was really a beautiful structure at that time, and this count went 29,509 to 30,177. Well, interestingly, in January, and I did some blog work and I also did some video work. I think, well, I don't think I did a blog, but I did video work on this area right here in January, because there was real evidence of distribution forming off of this peak, which was a throw over of another trend channel. So here are the anchor points here and here, and you can see the overbought line was drawn parallel here, throw over and another throw over January, February. January was the internal peak in the market, and February showed a number of breadth divergences, which we documented at the time in WMD and also in the videos, which showed that a number of stocks were actually making lower highs at that February peak. And of course, after that, you can see this huge gap and then just a failure with just massive amounts of volume. Okay, so now I'll come back to this chart. I want to show you the 62 analog. I've written a blog about it. We also did a video. But the point I want to make is that in 62, and I could go through all the reasons why the market really cascaded lower in 62, which was related to the steel crisis that President Kennedy had with the steel corporations, the steel industry. But really it was an excuse, because look at this beautiful distribution up here. But buying climax, automatic reaction, secondary test, a sign of weakness in B that undercuts the automatic reaction, and then an upthrust. I'm describing this as an upthrust after distribution. And then a response to that was this waterfall decline. Well, same thing happened here. So we're using this as an analog: buying climax, automatic reaction, secondary test, sign of weakness, rally up, and a throw over into an upthrust after distribution, throw over, overbought condition. So this is a different trend line. So I've shown you these other ones that became overbought at this extreme. Well, here's a different one. So all these different trend lines are all showing these throwovers. And then we draw this broadening formation that we can see in both of these structures. The broadening formation here goes down in the shakeout through the lows or through the declining trend line, and then interestingly enough, and I'll show you this in a minute, and also you can look at these point figure charts here. This is of the 62 period right here, and they work beautifully. But here's what happened since. This is through the April 2nd. But this huge bounce, so shakeout, huge bounce back up into the structure, and so possible selling climax, automatic rally. Now, the discussion that I want to have, and I'm going really fast because I want to get all this in the time that I have, is I want to talk about how we could have a potential accumulation structure form. Here's two different schematics. And accumulation can happen in different ways from this, but these elements should pretty much be here. You know, the different phases, phase C, the final testing phase, phase D, the rally up to and through the accumulation area, and phase E, which is the new uptrend. And so we're going to talk a little bit more about this, but I want you to keep in mind that headline news, remember, stock market discounts the economy, is that, and the top line news is the headline news becomes more bearish as accumulation turns into markup. So all the way through here, the news is going to get worse and worse. And I truly believe that we're going to be seeing that, is that we're going to see by the time we get to this phase C, phase D, it's going to be, the news will be really bad. There'll probably be bankruptcies, unemployment will be very high, the economy will be running at a very slow rate, and it'll be measurable by then. But let's talk about how long it might take to get from here over to here. So that's going to be our mission in the time that I have. This is just an intraday chart, 15 minutes, the Dow, big distribution count. I'm gonna show you some point figures here for a minute. And so this is only through the 1st, so you'll have to bring this up to date. But you can see here this distribution type structure. Well, I took a count here because I want to kind of make a point. So there's 2 counts I always try to segment, but I'm going to focus here just on the shorter count, which is 27 columns. And this goes down to this area 17,134, 17,000. And so keep those numbers in the back of your mind as we go forward. The lower numbers go down as low as, call it 15,400. And that's possible. Also, there's an accumulation count right here, which we'll look at. Here's that accumulation count. And you can see here that it goes up to around 22,800 right here. And we didn't quite get there. But this is possibly our selling climax, automatic rally. And so we didn't quite get there. I always think it's a little bit bearish when you don't completely get to your point and figure counts. Here, now we've gone to 18,250 down here as a first stop, and I'll show you another point figure, but this is a 60-minute data, 3-box reversal, 100-point scaling. And this count here, look how beautiful this distribution structure is. So big thrust up into final high, climactic in nature, and then a break, which is a sign of weakness, and then a rally into a last point of supply. This count across here, and this goes back to September, counts down to 17,200. Well, we just looked at an intraday count, shorter term count in the last chart that went down to what, 17,133. So we have 2 counts now that go down to that level. So keep this in mind. Here is sort of my main working count. This is daily 3-box reversal and using 250-point scaling. This count goes back to, from the last point of supply over here, counts back to April, May in 2019. This count across gives us a potential of 9,750 points. So this count goes down to 19,750, 17,250. 17,250 200 comes back into play again. We have 3-point and figure counts. So it's like the yellow brick road seems to be pointing to 17,200. So this is interesting. So we have gone into the middle of this count area, and this is at 18,250. In this chart, I just put this in so that you could see that we did in fact get down to this level before we bounced into an automatic rally, if that's in fact what we have so far. And I have a chart to demonstrate that in a minute. And so as we get down to this area here, first of all, look at this huge count. It's like, wow, you know, point figure just does such a great job, and so few people use it. And so horizontal point figure counting. So keeping that in mind, I just want to show you the S&P equivalent. People get mad at me because I look at the Dow all the time, but I do look at the S&P just as much. They both do really good counting, have good accuracy. So here, going back to the April-May peak, counting across, this takes us down to into this 2300, 2050 area. Well, we went to 2200, which is right here, just like in the Dow, then the middle of the area, and then the low there is around 2050. So that's a number you might want to keep in mind. And look at this, 1,050 points of downside potential in the S&P in the 2019 horizontal count. Okay, now we're back to this chart again. I want to just point out that in February, the thing was in January, we didn't get to this count level of 29,509. Well, in the final push up in February, we got up to 29,568. And we rallied up and finally got into the count area of this count structure here, which in this case, it threw over the top slightly of this count from this January back to December. Now, these are some notes that I did for you here, and they really relate a lot to the idea that we could have a selling climax here, an automatic rally here, and then a secondary test would be the next structure that we would look at. So potential selling climax, automatic rally, this gives us a range bound condition because we draw resistance at the automatic rally, we draw support at the selling climax. Point figure objectives have been reached on the downside, which I just showed you. Watch for diminished volatility as we go into secondary tests, more than one, and I'm going to show you some charts for that. Secondary test could go lower than the selling climax, bullish if higher. I'm going to show you an example of that because I'm going to do an analog. And so here you can see that the here's our two schematics. We have the one with the spring, which is a lower low, and then we have the LPS in phase. These are phase C final tests before the uptrend starts. And so in the case, this one's a very tricky one because you can see that each of these lows is lower than the prior. And so this becomes very difficult because it's psychologically debilitating to see the market, these indexes just go lower and lower. And it just reinforces the idea that the bear market's alive and well. Now, I got to keep going. So here, I've shown you this model before. This is the presidential election years of the last 116 years going back, and it's just looking at the presidential election years and summing them all together. And so you can see here that what I was initially looking for back at the end of the year was a rally, which we had, a rally in 2019 up into a high. Well, I think, and I'm just going to make a couple key points here and move on. I think that these peaks may have been moved back a month. So here's the February peak. And so this low, and you can see a little cause build here, gets moved back to the end of March, which is where we had our climactic low. And then this gives us the potential to have this a peak of sorts. We're not going to get back to the highs by any means. This is more of a cyclic low than it is a reaccumulation, which is what originally we were fooling around with. But we move this out to say May, and then this big grinding decline takes us to June, July, which is the classic place to start a good uptrend would be in the beginning of the third quarter. And this is an election year, and of course what they want is the administration wants to have the market rallying into election time. So that's a possibility, but I'm going to show you another example here in a minute. So here's our schematic again, and this is the one where we have the selling climax and then a secondary test in phase B that's lower, a spring or a shakeout which is lower. And so we have this grinding downward after a big cascading decline. So what I'd like to do is I'd like to create an analog, and what I want to use is I want to use the 2008, 2009 period. And if I can, I'm gonna just erase that ink. And so you can see here that this October low, let's say this was the climactic low. We could argue this is the climactic low. Sometimes climaxes come in phases. And so you get somewhat of a climax, and then in this case, we had a huge shakeout. But from the October low to the March low was 5 months. So we want to be patient and think in terms of causes taking time to develop. And we want to be able to identify a cause building with point and figure analysis, which gives us the potential. This is fuel being put in the tank for a new uptrend. And so now I don't expect that what we're going to have here is going to be anything quite like that, but I do, I think it could have a family resemblance. And I think that we're going to get a lot of top line news that is going to be ever more bearish for the economy as we go forward. And remember that the final lows in the market in an accumulation structure are made on the worst news. So we have to brace ourselves as Wyckofians because the news is going to get worse, and we are going to want to be prepared and ready for the phase C lows, the phase D rallies, and be prepared to put capital to work when the market is ready to turn on the worst news. And so this is very important for us to steel ourselves for this. This is what we're going to be doing in the Wyckoff market discussions, is to be preparing for this. Now, the one caveat is, and we'll be watching for this, is if this is redistribution for another decline. So this is just laying out a scenario. So let me put this schematic on here. I hope this works. So it's going to be a little harder to see, but I laid out the schematic so that it lined up to this 08-09 period. And you can see how well it worked. Here's the climax, automatic rally here, and then a secondary test which came to a higher low, which produced a rally, and here's the rally peak here, and then another decline, which grindingly went lower and lower and took out the 2 prior lows. And this is a secondary test in phase B, and then a long grinding affair up into a peak in the middle of phase B. And phase B, we know, is just extremely volatile period, and then the long grinding decline into the spring or shakeout. I actually think of this phase C in 2009 as a shakeout into March because it was so deep. And then after that, a reversal and just a push right up to the top of the range, and then a backup and an LPS, and then the beginning of a really important long-term uptrend. So this whole structure from the selling climax to the spring took 5 months. So if we look at March as being the low of the selling climax, and I'm just at this point just really guessing about that because we'll know this is done when we see it. I'm just laying this out as a possibility, is that this puts us into July, August. And so it may be that it even happens quicker than that because we have the thing that we have going now is we have the Fed just, throwing $2 trillion of liquidity at these markets. We have Congress creating fiscal stimulus to the tune of $2 to $3 trillion. They're talking about an infrastructure bill. All of these things are going to come together and eventually, and so the ability of government to act more quickly on events like this are really showing up here. And I believe that this could be the fuel that lays out the conditions for the next uptrend. And so we'll know it when we see it, but this is one of the scenarios that I would like to focus on and at the time be prepared mentally to be able to put capital to work. We did a really good job of identifying the risks at the top. We got low to the ground, we got small, got out of the way, protected capital. That's what Wyckoff is so good at. The Wyckoff tools were spectacular in this situation on so many time levels, etc. And then we wait with our capital intact for that right moment to put capital back to work for a new glorious uptrend, and we'll know it when we see it. So to conclude, building a cause takes time, but it doesn't take that much time. But it does take time and patience. So be patient. Wait for phase CDE, however it shows up, whether it be a spring shakeout or a last point of support. Employ point and figure to estimate the potential for how much fuel there is, and then be alert for redistribution, and we'll know that when we see it also. And with that, I did it. I'm done.
Bruce, that was great.
Thank you.
Such a great synopsis of all of the thoughts that you have in such a short period of time. So let's go to some questions. My first question to you is, you talked a lot about projections, targets that are based on the point and figure horizontal count. And we have the audience that might not necessarily be that familiar with this technique. Could you just give us the high level explanation on the logic behind the PNF horizontal counts?
Point figure charts are constructed not based on time. So when you look at this chart, you can see it's a function of time. Every, in this case, day gets an entry. Point and figure is a function of volatility. You can only go to a new column and put in entries of new X's or O's based on a certain amount of volatility occurring in the opposite direction. And so you get volatility developing the counts or developing the columns, and then there's this age-old methodology. This is a 150-year-old technique that you count across the columns in a certain fashion, which we have discussed, and there's tutorials on this, and I've written about it in the blogs. You count across based on these conventions, and it gives you the potential for how much prices can move up or down. There's 1 box reversal method, 3 box reversal method, 5 box. We employ them all just based on time frame. Roman, how big was the count on this 0809 structure when we counted it with Hank?
Well, that was going into the 17,200 on the Dow.
So 17,200. So, and the count line was
much higher.
9,000. So, but the original count area of the accumulation range was that 7,000? I just forget. I forget the numbers. I'm getting old.
Well,
And
let's go to some other questions. There are quite a few.
Yeah. Yeah,
So
sure,
maybe we could just go very quickly through those.
sure.
Judy is asking, the shape of the SPX now is much like December 2018. What if this is just another V bottom?
Well, I wouldn't completely rule that out. I sort of believe in the idea of um, alteration, or what's the term that they use for this time. I think won't be like last time, and so we got a V bottom low. I think it's possible that we could get another V bottom low here, but I think it's just not likely. I think it's more likely that we're going to build an accumulation, and it's going to take a little bit of time, because I think that the news, I think it's really related to news. I think that there's going to be more bad economic news as we go forward, and we want to be detached from this news. We want to watch it, pay attention to it, see how the market reacts to it. But the news is going to get worse. I've never seen something like this in my life. This is why it feels like Oz to me, where the whole economy has effectively been shut down around the world. And so how the economy gets going again, I think it'll be slow and halting, and it'll take time. But I do think that the stock market could go up in a steady fashion once we get an accumulation in place, because there is abundant liquidity that's being pumped into the system.
Bruce, another question. This comes from Alan. High the volatility means less time to build the cause, or the opposite?
Brilliant point. Really good. Volatility is always highest early in accumulation. You can see that in this 08, 09 example. The volatility is quite high. Count gets built in point and figure quickly on the beginning of accumulation, more slowly as accumulation comes to a conclusion, because you can just see here, looking at this visually, how the volatility is diminishing, and you can see it in our schematic. Volatility is very high on the left side and quite low on the right side. And so count gets built, but it is built quickly, because volatility is a function of stock changing hands. So when you get a lot of volatility, that means a lot of stock is changing hands. In an accumulation, the description that Wyckoff would make is that stock is going from weak hands to strong hands. And so the weak hands have the stock into the climaxes and into the early phases of accumulation, and the stock goes from weak hands to strong hands as accumulation completes.
Bruce,
Very good question. Very
there are
good
quite a
question.
few questions on the point and figure charting and how to calculate horizontal counts, and all of those questions are going into the details of how you actually construct the counts. What would you say in general, just where people could get this information from you, or from some other sources?
Well, Roman and I have done a series of tutorials, workshops that have been bundled up into courses, and then we did 3 of them. And then I've written on the point and figure counting and how to do it in blogs, especially some of the early blogs in 2015, 2016, and those are all archived at Stock Charts. So you can certainly go there and look at how to do that.
And then, some questions on the current, news cycle and where we are, from Franz. How does a treatment of vaccine potentially could impact phase formations?
Say that again, just to make
Uh,
sure that I understand.
If they find the vaccine, what's your opinion how the structure could unfold if something positive comes out, just in the near future?
Yeah, I think that it could create a big bounce in the market. But see, now I think that the big fear is how much damage has been done to the economy. And so there's going to be it's going to take a while for the economy to get moving again. Could take a long time, actually. And now the whole discussion is going to be about how long this is going to take and what's going to be involved. And there's going to be bankruptcies. There's going to be some defaults on corporate debt, and and also mortgages and things like that. And it's sad. It really is. And I mean, I could go into my own opinions about things, but I do believe that these are things that we're going to be grappling with in the summer, and that could be the psychological low for the market. So just remember, the psychological low, it comes with the depths of the worst news, and that sets up the low risk bottom in the market. And that's really one of the key points I want to make here in this presentation.
Bruce, what a great analysis. I absolutely love your 1962 analog, and it just has so much merit if, we indeed gonna have a secondary test, and then out of this deeply oversold condition, have a rally. The discussion about 2008 low, 2008, 2009, and how it formed is also very informative. Actually, I'm going to be talking about this as well a little bit. So thank you so much for your presentation. Thank you for being here. Thank you for contributing to our Wyckoff Nation in such a significant way. We always love your work. Again, please check out Bruce's work on stock charts at wyckoffanalytics.com. Come to our classes on Wednesday. Together with Bruce, we go through this analysis on the weekly basis. Bruce, any
Let me
other final comments, thoughts?
final comment, promise. One of the things about the 62 analog, and it's so eerily prescient to the moment that we're in, is that in 62 there was a cause built, and that cause was built, and the higher low, believe it or not, was the Cuban Missile Crisis, a much bigger problem for existentially for the world than steel prices, which is what the cascading down was. And it was a higher low. The Cuban Missile Crisis was really bad news, and it was a higher low in the market. And maybe that's what we get here. But we built a cause in 62. It took about 4 months, and that cause produced a kickoff for a rally that went from 62 to 66 and had nearly 100% move in appreciation in the index, and took the Dow to 1,000 for the first time. So that is one of the things that I think is so promising about the 62 analog. But keep in mind, what kicked off the low in 62 in October was the Cuban Missile Crisis, which was a really bad news bottom. And so wait for the cause to be built. And thank you so much to everybody. It's such a blast to be here with everybody.
Bruce, thank you so much. We really appreciate your input. All right, guys. Well, let's move on, and let's move to our next presenter. And let me just switch the screen really quickly. And I'm extremely grateful to have our next speaker at this event, Dr. Gary Dayton. And I've known Gary for some time now. We've talked on multiple occasions, and Gary was a presenter at the Best of Wyckoff. I follow his analysis on Twitter, so please find him on Twitter. He is regularly posting his analysis of the markets, and he's an extremely knowledgeable tactical trader. And when I say tactical trader, I mean just figuring out, those short-term moves that start building the whole structure. And it's just uncanny sometimes, to read his analysis and then just to watch the market and just see exactly, what Gary has predicted to happen. Another element in Gary's arsenal that I would like to mention is he's a trading psychologist. And for those of you who are interested in this type of information and skill building, I would highly recommend going to Gary and signing up for his courses or for his private sessions. Also, Gary is an author. He published Trained Mindfully, and this is the book that you have to have, in your library. And with that, Gary, I think that you have to unmute yourself. Are you there? Hi, Gary.
There we go.
Okay.
How's that? You hear me okay?
Yes, absolutely. Well, welcome and thank you so much for being here with us today. I'm going to switch the screen to you and we can start.
Okay. Let me pull up the slides here. And as I do, I want to...
I can see your screen.
Okay, good. Yeah. Yeah. You can see the screen okay, right?
Yes.
All right. Sorry, I'm just getting a little more organized here. So, hi, thanks first of all to Rahman and to Wyckoff Analytics for, excuse me, for inviting me here today. It's really nice to talk about Wyckoff and some of the applications that I do with it. Just as a quick background on me, you heard that I'm a trader and also a psychologist. I'm basically a day trader. So my opinion on the bigger market and what's going to happen probably isn't worth all that much compared to some of the other speakers here today. But what I will talk about more is a little bit about day trading and how to handle it in this market. And as Rahman said, I'm a psychologist as well. I was trained as a clinical psychologist, worked as a clinical psychologist, working with people with depression and anxiety and schizophrenia and those sorts of things, but also had the opportunity to work with a terrific sports psychologist, a fellow who was actually the sports psychologist for the Cleveland Indians Major League Baseball team and the Cavaliers basketball team. And I spent some time with a year with him learning how to take psychology and apply it to human performance. And from that, because of my interest in trading and my activities in trading, I brought that into trading as well. So, and I do work as a psychologist, both with a couple of hedge funds and also with some individual traders. With the hedge funds, I'm mostly not doing technical work with them, helping them to kind of determine whether their thought process, their decision making is nice and crystal clear and it's not clouded up by emotions and different biases that we commonly have. And with individual traders, I'm helping them work on their mental game. And one thing I keep hearing about is that there's a lot of, with the individual traders I'm talking about, in this highly volatile market that we've had the last few weeks, is that there's a lot of over trading going on out there. The volatility seems to bring that out. Traders are complaining that they see the market move 8, 10, 12 points in a 5-minute bar. Tremendous, right? And they start jumping into unplanned trades if they're not into the market. And of course, that leads to losses and other problems. So I thought I'd take this opportunity. I wanted to talk about let's get down here to what we're going to talk about. I wanted to talk about a psychologically sound tactical approach for trading in this environment and for any environment, really. But it really does shine when it comes to when the volatility picks up, as it has. So we'll talk a little bit about this tactical approach and see how it's applied. I'll show you how I applied it in yesterday's day trading. And as we do that, I'll bring in some Wyckoff as well. And Rahman, you're free to ask questions as we go along. That might be easiest. We can wait till the end if you want to, but I'm happy to take questions in the middle of everything as well. So don't
Sounds good.
feel like, yeah, don't hesitate to do that.
Will do.
So what is this approach? Well, it's not very mystical. I call it before, during, and after. So, and it relates to what we're doing before trading, what we're doing while we are trading or during trading, and what we do after trading is over. So what do I mean by before trading? Well, before we trade, before we enter the markets, we want to prepare for the next trading day. And this applies to swing traders as well and position traders. You want to prepare for the week or the trading day. The applications are the same. And during trading, we want to execute against our preparation. Why do I separate them? Well, think about this for a second. If you're in the middle of a trade and you're wondering, oh, where is weekly support? I better go figure that out. You know, you're behind the 8 ball at that point. You're doing a before activity. In other words, you ought to know what that is before you walk into the markets and start trading, start making trades. In the middle of a trade is not the time to be preparing to make a trade, okay? So we separate them logically. There's some overlap, of course, but in general, it's helpful to think this way conceptually. And then once trading is over, afterwards, we want to assess our performance. And again, we don't want to do this in the middle of trading. We want to wait until the trading day is over, when we can turn our full attention to how we did and the decisions that we made during the course of the trading day or the trading week, whatever your time frame is. So let's take a look at preparing for the before activity here, preparation before we go in trading. And as a Wyckoff day trader, I start with the daily chart. Now I'll look at the weekly and even the monthly to kind of get a sense of where we are in the bigger picture of things. But in day trading, the daily chart is key to this. And I'm not interested in Fibonacci numbers or floor trader pivots or your Aunt Sally's ratio of ingredients for her world-class pancake batter, as you might apply it to the markets. I'm not interested in any mythical kind of numbers at all like that. Not interested in the hidden stuff. What I want is I want the obvious. I want it to be sticking out there like a sore thumb. Why do I say that? Because everybody else sees that as well. We know where yesterday's low was. We know where yesterday, or most of us know where yesterday's high was. And if you look, let's see if I can get a pen here. If you look at any day, here's yesterday's high and low. You can see that there was trading around that. We come up to yesterday's high, there's trading here. It stops at the 2-day low. We go through yesterday's low. Now we come back up and look, we're back to the 2-day low again and the 2-day high, excuse me, and yesterday's low. So from a day trader's perspective, the daily highs and lows are vital information to know. So we would look at yesterday's high, we'd look at yesterday's low, we'd look at other areas that were prominent here. So if the market turned up into here, where is it likely to go? It's likely to run into trouble up in here. So I'd look at the 3-day high up in that point, up in that area, okay? There's also a little bit more not sophisticated, but a little bit more complex maybe. You can see that on this day where we made the low, we finished off, the high was made at this point, and we turn around, we run through it, and we come back down to that 2-day high back in there. So that forms a little pocket in this area, right in here. And sometimes those pockets are meaningful. And so when the day ends, as it did here, close to one of those pockets, I'm aware of that. and that happened to be at this level here. The high was 23.86 and the low was also 23.86 on those 2 days. So I'm interested in those. I'm also, you'll see this, we don't just look at the daily and then go from there. I want to look at a larger time frame intraday chart. The 4-hour or the 3-hour chart is useful for this, and I'll show you that in a minute. But we see this, I've got this number here, 2,500. If you've been trading the last several days, including this morning, before I closed down the charts and came in, 2,500, we had come up, I think, to 25.25 last night or yesterday. And then we were back down underneath of it earlier this morning. So this was a level where you'll see on the 240 chart where we had some resistance and then it became support, and you'll see it more clearly on the higher time frame intraday. But that becomes important, especially in a trading range like this. And we call it, let's go to the 240-minute chart for a moment here. We call it an access line. And this, for those of you who don't know me, I was trained in trading in the Wyckoff method by David Weiss, who's going to speak a little bit later today, I think. And David's a good friend and a wonderful, wonderful teacher. I really learned how to trade from David, and the vast majority of my trading comes from what I learned from David. And of course, like all good professionals, you take what you learn and you kind of make it your own. And so I took things from David that he taught me. I didn't take them from him, but he freely gave them to me, generously gave them to me. And I've worked with them over the years. I think David and I started back in, I think in 2000, maybe 2003 or 4, 2000, certainly in 2006, I was doing some work with him. So we go back a ways. One of the things that David taught me was this concept called an access line. And I generally put those in purple. I like to color code things because psychologically I can remember them and they're more meaningful for me that way. But you can see that when the market had come down to here, it hit the 2,500 level and tried to find some support there. And by the way, 2,500, it's not a number, it's not a point, it's an area. So we go up a little bit above it, or we are down a little bit underneath of it, but it still holds. It's the general area that we're talking about. But you can see that we tried to have some support here and then fell through. We rally up, tried to find support again on that level, fall through. Now it becomes resistance. We get a little up thrust. As I say, it's not a number, but it's the area represented by this line. Again, resistance. So it's support and support, resistance here. We drop down, becomes resistance here again, right? You see how important this becomes. Now we flush down, we make that low, we rally up, it's resistance again, and then we kind of rocket through it on this time frame here, on this 240-minute time frame. This is 4 hours during the course of the day. So we rocket through it, and typically you'll see that. We often gap through or drive right through an access line. Kind of one of the things that, and I forget if David taught me this or if this is something that I kind of came up with on my own, but in any event, it kind of gives added weight to this access line because the professional players are driving it through because they understand, they see this this market rotating around this area, and so when they want to go through it, they frequently drive it through. But look, it comes back and it tests down in here again, right? Rallies up, and then we're back down around that 2,500 line for yesterday's trading. So this is really important to me. this I want to pay attention to. So daily highs and lows, the 2 or 3 day high and low if it's important. The little pocket area that sometimes forms can be significant, and particularly these access lines, really useful areas to look for trades to occur. Now, why do we pick those? Not just because there's a lot of trading going on around them, but when I'm intraday trading, when I'm trading off of the 5-minute chart or the 10-minute chart, and I can lean against yesterday's high as resistance, or yesterday's support as resistance, or this access line as resistance or support, then I'm using multiple time frames now, and we do that a lot. When I day trade, I'm trading off of the small time frame, but I'm looking at the hourly and the hourly chart and the 15-minute chart as well, not just the smallest time frame of the 5-minute, or as I'll show you in a minute, a tick chart, which I prefer over a 5-minute chart. So that sings out at me in my preparation, right? We haven't entered the trading day yet. We're still preparing. I notice also that we have a typical little rally up into the, looks like around 26, we'll call it 2650 area up in here. And as we go up, I notice the shortening of the thrust here, right? We make nice progress here, and only a little bit of progress here, and then very small amount of progress here. So if you think in terms of waves of the market, which Wyckoff was a big wave thinker, I think maybe he created the waves, thinking in terms of waves, and he had a Wyckoff wave, and we'll talk a little bit more about in a few moments. You can see that the waves, the up waves are getting smaller, right? And the down wave is starting to get larger, right? That's important. And that gives me a bearish tone. It suggests that supply is entering the market. Also, I know that we make good progress up here. We break through the access line of 2,500. We've got that kind of volume. And now, by the way, on a 240-minute chart, it's the last 3 bars that are the American session. So you're going to see most of the volume in that area. In the Asian and European sessions, this is the Globex market for the S&Ps, the S&P futures. So you're not going to see as much volume in here. I'll give you a clue, though. If you see significant volume in the middle of the Asian or European session, that can be significant. That can be important. We don't see that here. It's a bit of an anomaly when that occurs, and those anomalies, as Bob Evans, who was the head educator for Wyckoff Associates back in the firm that Wyckoff established to teach the public. He ran the education component of that from the 40s into probably into the early 70s. But he would say, when you see abnormal volumes, stick a wad of peanut butter on it. Of course, they didn't have computers back then. But he was trying to make the point that while we may not know what the significance of that volume is, big volume is always significant, and you need to pay attention to it. And eventually, the market will tell you what that volume is all about. So we don't see that here, but that's just a sort of a little side tangent and a little tip to watch out for abnormal volume. Notice we don't get abnormal volume here, though. As we go up, we see the shortening of the thrust, and we also see the volume diminish. As we make the new high here, I bracketed the key days, this day, and the move up to here. It might not be so obvious because of the price action in there. But you can see that by the time we get to this day, volume has dropped off quite a bit. What that suggests is that buyers are losing interest to the upside. They're not chasing price up any longer. And that gives the opportunity for sellers to come in. So on this day, I'm looking at this and noting daily high and low, the access line, and seeing that on when I drill down into the daily by using this 240-minute chart, I see shortening of the thrust up here and diminished demand as price increases. And so my overall tone has a bearish biasness to it. Doesn't mean I won't trade to the long side on the daily time frame, on the intraday time frame. But it does suggest, it does mean that you know, if we start heading down, if we start going down, it should be pretty good trade because there's bearishness in the background. I'll also note, however, that a potential spring is setting up. So my mind is got that bearish bias, but I'm going to try to maintain an open mind as well, because we could also rally up and have an up day before we finally stop moving up and the bears take over. So that's the preparation, and I'm ready now to go into the next day's trading. So let's take a look at that. And this is yesterday. Did I spell April right? Yeah, it's April 2nd, 2020. And so, Ramon, just kind of remind me, what have I got here for time left?
We've got about 10 minutes.
Okay, good. Okay, so I'm using here, I don't use a 5-minute chart very often. I prefer to use a tick chart. What's a tick chart? For those of you who don't know, a tick chart is built not on time. You know, a 5-minute chart, every 5 minutes, the bar starts anew, and we start painting a new bar. Here, it's the ticks, which is actually the number of price changes that occur. You can think of it in terms of the number of trades that occur. It's not quite accurate because sometimes you can get a trade that doesn't change the price, and so that won't add into the won't become part of the tick bar. But if the price changes even a quarter point, it does become part of the tick bar. So when there are 3,000 price changes, we complete a bar, or when there's 3,000 trades, if you want to think about it that way, it's okay, we complete a bar. Why do I use this? It's very easy to read the overnight action. A 5-minute chart would be difficult to read. It's not that it's unreadable, it's just this is much easier. I also get a little bit of a finer grain on this. On a normal market day, this would be like a 4, 5, 6-minute chart, somewhere in there. When it's really slow, it gets to be like a 10-minute or a 15-minute chart. And when it's fast in the high volatility days, it's probably more like a 2 and sometimes even a 1-minute chart, right? In any event, I'm using this. Now, one of the things I notice right off as I come in the next day, I'm going to identify the overnight high, and I'll put that on my chart. I've got yesterday's low on my chart, right? And I notice, oh, look at this. The overnight high comes in at 25.02 1/4. That's my access line, right? And I can see that we make that high, and we could draw a trend line in here and see that we're overbought up in here. We make a lower high, a lower low, lower high, and a lower low, right? So that's the definition of a downtrend. I don't get more sophisticated than that. And I notice also that now I'm using the Weiss wave here. When we're trading intraday, the intraday volumes are useful, say off of a 5-minute chart, but they tend to produce that smile. They're big in the morning and they're big in the afternoon, and during the middle of the day, the volume drops down. So it becomes a little bit more difficult to read, not impossible. But David created this Weiss wave, which if you look, you can see, we'll start here, and you can see we go up, and this Weiss wave is accumulating the volume. So this is the volume on this wave. And then we come down, and it's bearish, it's downside. So this is the volume here. We come up a little bit, small volume, no demand up, that suggests, compared to this, and we come down. So you can see that when we think in terms of waves, right? not only do we have price bars here, but we're using a component of the Weiss wave, the volume component, and this shows us the volume on the wave. So we're able to do two things at once, so to speak. And I notice that we're coming down, and we've got the lower highs, lower lows, as I say, and supply has overcome demand. It's dominant here. It's dominant over demand. When we were going up, demand was strong, supply weak, coming down. Demand is weak and supply is much stronger. So now I see that we've hit my 2500 access line. We're coming down with good supply. We come into a local resistance here, and on the rally up, I notice no demand here. No demand, right? Modest demand coming up. And I look at the price action and I see a lackluster rally. How do I know that? Closes in the middle, shortening of the thrust, little, they're not really up thrust bars, but weak bars in here, and an inability to get above the high here. There's no follow through above the resistance. So that becomes a good spot for a trade. And I'm confident, I have confidence in that because of my preparation the night before. Say, oh, look, 2500 access line got hit and it gets reacted off of. Now we're at resistance, supply is there, no demand, poor price action, let's go short. And that's what we do. Let's see how this resolves itself. So we go short here, spend a little time mucking around in the underneath this, and then we start coming down. So now my trading, especially when you're short up in here around 65 and you come down here 15 points later, hey, that's a gift, and I'll take at least a piece of my trade off. Newer traders, I would advise you take it all off. Build your bank account up so that you can eventually get to the point where you are trading longer. But I would take a piece off here because you don't know if it's going to bounce back up again or not, and then try to hold for, oh, look at this, yesterday's low. That becomes my target. And as a tape reader, this is what I'm interested in. I've got this target down here, and I'm tape reading. In other words, I'm looking at the chart and I'm saying to myself, are we making progress towards this target, towards yesterday's low, or are we rallying, or are we moving away from it? That's the essence of tape reading. And I can see I've got nice, good closes coming down, good spreads on the, or ranges on the price bar, price action and stuff. And we go down to yesterday's low. Well, that's an important point for us, right? Notice that a couple of things here on this. Not only are we now in the oversold condition of the trend channel, and Bruce had told you about creating a trend channel off of two adjacent points and then doing a parallel here, right? When we get down into this area, sometimes we get a little overthrow or overshoot, sometimes we don't, but when we're down here, we know that that's an area ripe for at least a pullback. And you can see the price action in here respects that, and we push on up, and we're up now above yesterday's low. And I'm looking at this, as we come down, I don't see a lot of supply down here. So, and we've penetrated yesterday's low, and now we're back up above it. So this becomes a spring, a daily spring. And I'm trading now off of the intraday here, right? And now I'm using the daily to lean against. And yes, I have a supply line here, but this is a 3,000 tick supply line. We are very close to breaking this. And my bet is that yesterday's low, at least for the time being, is going to hold. It's going to be stronger than a 5-minute or a 3,000 tick supply line. And with no evidence of ongoing supply down here, I'm anticipating this to break, right? So let's see what happens with that. And it does break. And again, we come up to what had been resistance here. I'm sorry, not resistance, what had been support, and we can anticipate at least an attempt at resisting, and you can see that the market does, for a bar or two, does turn down, though jumps right through it. But taking a piece off of here is not, in my judgment, you book a few profits at logical points when they are offered to you. So I'd take a piece off here and I'd let the rest ride. We come back up to where we've made that first trade here. We're back up into resistance. And I notice, again, the shortening of the thrust, some clustering of closes in here, meaning that the closes are basically the same amount over a couple of bars, and no ability to push off from this support here. So this is, this resistance here, so this line. So this is my exit right in here, okay? And a nice trade, very nice trade. So again, I'm executing my preparation. I'm executing my plan to lean against yesterday's high and low, if they're offered, to lean against that 2,500 access line when that's offered. Just to finish up here, we do actually go up later on in the morning. We make a new high around 25 or just under that here. So we push up above the 2,500 access line. But as I said, it's more of an area than a line or a point drawn in the sand. And I noticed that although we get nice demand up in here, it falls off. We form a low, a potential lower high. We don't really know that it's a lower high because this could break up in here. And then, but we're back at the access line in here, right? And I look at this and I say, not a lot of demand. You know, when I look back here, this is what buyers were doing on in the same area that I'm in now, right? Made a lot more demand up here compared to this. This is puny or minuscule. So this is no demand in the wave structure. Remember, the Weiss wave is doing the volume on the waves. So there's no demand here. And I also noticed that supply really wasn't all that strong, but look at this. We come down and it's quite a bit more than what we saw earlier. So there's evidence of supply in the market. We are also at a, we have this trend line coming down. Not, I like horizontal much better than I like diagonal trend lines, but this has, let me erase this so that I'm clear. This has a couple of touch points, and generally the more touch points we have on a diagonally sloped trend line, the better or the stronger it is. So I've got this as a supply line, and I have my access line up in here. So I can lean against both of those, and together you've got a little confluence of resistance in here. I'll also notice that although we push up nicely compared to the first pullback I showed you earlier in that morning, same thing happens. We get shortening of the thrust in the price action, of the price bars. We get negativity coming in and an inability to push up and through the diagonal trend line and to rally away from, you can consider this the danger point, right? Rally away from 2,500 as the danger point. So this is a good spot to make a bet and we're also into congestion over here too. So it's not a bad spot to make a bet to the downside. We're leaning again against our preparation, and this is what happens. Now we push down, we get good volume coming in. Notice in here, we get the shortening of the thrust and the clustering of closes. So a smart trader would take it off. I wasn't so smart when I did this. I didn't take it off until it came back up in here, but that gave you firm indication in price action that we were potentially going to spring this and it was time to exit this trade. And we didn't get all the way down to the bottom of the trend line either. So there is some shortening of the thrust going on in here on the larger waves in this as well. So that's how I do my preparation and execution in day trading. And we don't really have much time left here, I can see, so I won't go into this, but just to be kind of try to complete this. After trading is over, we want to engage in what I call constructive self-assessment. And there's two basic questions you ask yourself. What did I do well today? Where did I fall short? You know, for me, on this day, I could say, oh, I did pretty well with identifying the areas to take trades. I didn't do so hot over here. I should have gotten out in this. So I'd make a note about that. And I'd say, okay, there I kind of was getting a little greedy, and I should just be more attuned to trading the price action rather than what I'm thinking about, because my mind often delivers up a lot of fraud, especially when I'm trading intraday. And so where did I fall short? There it is. Is this something I need to, what can I do here to improve? If I can improve that, then my preparation gets better and my execution gets better. And it's all a big process that we go, or not a big process, but a simple process that we go through to become not only, you know, have our trading be better, but become better traders as well. So hopefully that will be of help to some of you out there, particularly the day traders, and particularly the folks who are finding, you know, I'm over trading a lot, jumping in and out of the markets. This is a tried and true method. We've been doing this for years. The daily highs and lows are key levels, and that access line can be a key level, and you can lean against those. And when the market gives you action that's consistent with that, your confidence can go up, and, you know, hopefully your trading goes up as well. So that's what I've got, and I can end it here if that helps.
Gary, thank you so much. I was just following your logic as you were going through the tape reading. You know, quite fascinating how you view the tape, and you know, obviously a lot of similarities, you know, in tape reading. I was just enjoying your analysis, and just looking at the trades that you were putting on made a lot of logical sense to me. A couple of questions here. There are quite a few questions on the tick data, so some basic questions maybe, but you know, let's answer those. Where to find tick bars charts, and then are tick charts different or alike as a PNF charts?
Okay, yeah, they're, in terms of point and figure charts, they're more like a standard bar chart, like a 5-minute chart. It's just instead of using time, a 5-minute chart is based every 5 minutes, a new bar paints, right? This is based off of activity. So 5 minutes are based on time. Tick charts are based on activity, trading activity. So if you're using indicators like stochastics or MACD or any indicator, this standardizes the data against a market relevant characteristic. Time isn't relevant to the market. We know that in point and figure charts. So in that way, tick charts and point and figure charts are similar. They ignore time, and they're based on activity. But we're not painting point and figure charts. We're painting bars here with the high, low, and close. You can get an open here, and if you want to do Japanese candlesticks, you can do those as well. I've never found those to be particularly useful. This is nice and clean. I see what's going on by this. So where do you find tick charts? I think most trading platforms, and I use TradeStation and multi-charts, both when you bring up a chart and it says, do you want a 5-minute chart or a daily or a weekly or a point and figure or a Kaji chart or whatever, you can say tick, right? You can say, I want a tick bar chart. And technically they're called equitick charts, I think, or sorry, I'm trying to do this with a mouse. That's an I. Equitick is the formal name. Equitick chart or equitick bars. And so you can get that right off of your trading platform. And I use 3,000. You can adjust this if you want. You can make it 5,000, 4,000, 1,000, 250. I've just used this. I find it to be a good value to use for
Gary,
that.
quite a few questions, so maybe just one-liners answers.
Mhm.
How do you trade in volatile environment when even 5 minutes bars are wider than acceptable, even in the areas where you have to lean upon? What do you do?
Yeah, trade small and trade smaller. So what do I mean by that? If one contract on the S&Ps is too much risk for you, then go to either shares of SPY, the ETF for the S&Ps. It trades identical to the futures, or you can go to the micro. I traded that not too long ago because somebody asked, and I really wasn't all that familiar with it. But it's a good little. It's 1/10 of the size of the S&P E-mini. So it's like instead of $50 a point, it's like $5 a point. So that will help you reduce. You can make a larger risk. You
Gary,
can, yeah.
um, yeah, so I'm just trying to speed up a little bit here, and quite a few questions and quite a few, you know, thank yous for your presentation. A question from Brian. Is it fair to describe your approach as deciding how to act prior to taking action?
Not necessarily. It's in preparation. I'm looking for the areas where I think trades are likely to set up. And you can get pretty good at this. Maybe 3 days out of the week, you can kind of pick the low of the day or the high of the day, depending on how the overall market's been trading, just by the daily highs and lows doing this. So I'm not saying, okay, I'm not saying when it gets to the low, I'm going to buy. I'm doing the analysis there in flight, but I'm using those as the spots where things are most likely to take place.
Hmm.
It,
And
is
then
that?
there are a couple of questions about David Wise Wave that you are showing here on this slide as well. And
Mhm.
people are asking, do you use this exclusively? Where do you get this? And I mean, David's going to come up and we're going to ask the same question. But, Gary,
Yeah.
maybe you could just quickly tell us exactly what you do with
Yeah, if
this
you
one.
can, get David to tell you how he came up with it, because it's a fascinating story. And this goes all the way back to 1910 when Wyckoff first published his tape reading chart, which was a combination of volume and point and figure. And David, working with that for years, discovered this way of kind of conceptualizing it. And it is just I always say to people, hands down, this is the best indicator I've ever used. And I've used a lot of them over the years. And this is what I use for intraday trading. Um, so get David to talk about the Weiss wave.
Absolutely.
That's his thing, and I just use it. It's available from David off of his website. We also sell it as a Wyckoff product, and David gets money for that as well. But either place you can get it.
Sounds great. Gary, one last question from me personally.
Sure.
And we'll stop there. I just want to get your professional opinion, both as a trader and as a psychologist. Obviously you've answered the question about, how do we deal with such a volatile environment where we have to adjust our stop losses, sizing, targets, and so on and so forth. So this is more technical. But from the psychological point of view, and just kind of like talking about just people, how do we go through this time, when we are in the lockdown and we still have to trade? I mean, that obviously influences us in a certain way. What could be helpful?
Yeah, there's a lot of noise going on around there. There always is, but in times of high volatility and potential bear markets and all of that, the volatility increases and stuff. And you can't control that noise. And what we do is we have an idea, we have a concept called mental parking. If you worked in an office building, say, and you commuted in every day, you'd get in your car, you'd drive to the office, and you'd park it in the parking lot. And you're not thinking about your car all day long until 5 or 6 o'clock comes and the whistle blows and you go out and you get in your car and you go home.
All
It's the
right.
same idea with all of this. Put it aside, mentally park it. It's irrelevant to, especially the kind of trading I do, and really the trading we all do. We're technical traders. We're not trading off of news. We're aware of it. I certainly know when reports are coming up or when the Federal Reserve is meeting. You know, there's those days tend to trade differently than other days. So I'm aware of those, but I'm not making bets against those. I'm not saying, oh, the unemployment report is going to be XYZ, and so therefore I'm going to take a long position or a short position. Oh God, I could never even think about doing that. You got to just mentally park all of that stuff. Put it aside. You can deal with it after the trading day is over. You can watch the news. You can talk to other folks and stuff, but keep your mind focused on the tasks at hand, and that's trading the market. Now, mindfulness, I'll just say this in kind of closing here. The most important, I believe, the most important method or technique that we've developed over the years is mindfulness for that kind of stuff. It helps concentration. It helps you be able to mentally park that stuff and keep it out of your trading.
Gary, what a wonderful advice. Just to tune off, do your job, and then after that, go and figure out what's happening in the world, and using that awareness and mindfulness, not just in your trading, but for yourself as well. Such a great advice. Gary, thank you so much. And for more information on Gary's products, go to his website, tradingpsychologyedge.com. Gary, it's always such a pleasure to have you on. And you know, I'm following you on Twitter. I'm following your analysis. I'm reading the tape with you. So thank you for that.
Well, thank you, Ramon, and your group there, Wyckoff Analytics, and also thanks to everybody out in the audience that you're listening to. It's, you know, trading is a tough business. There's no question about it. It creates all kinds of demands on you. So you know, pat yourself on the back for doing this. It's not the easiest thing in the world to do. So
Absolutely.
Thanks a lot. I appreciate you listening to me.
Thank you,
Take care,
Gary.
everybody.
Thank you.
Thank you.
All right. Well, let's move on. Bruce, are you there?
I am here.
All right. So
great presentation, Dr. Gary. Thank you so much. That was wonderful.
Absolutely. Bruce, please announce me. I can't announce myself.
Well, we have the great fortune of having maybe the premier Wyckoff educator in the business today, alive. He's not only a great educator, but he's a great practitioner of the Wyckoff method. And the thing that Ramon and I both have in common is that our teacher mentor was Dr. Hank Pruden, the legendary Wyckoфfian who has done so much to move forward the whole Wyckoff method approach with his wonderful teachings and his book. And we both had the incredible opportunity not only to study under Dr. Pruden, but we also had the ability or the great fortune of being able to learn how to teach under Dr. Pruden. And I think that Ramon is just, I think, at the pinnacle of the teaching of this method personally. And so I do the best I can. I've been teaching, I taught the Wyckoff method with Hank for 27 years. Ramon came along in the mid 90s and just absolutely fell in love with the whole approach, studied extremely devotedly the approach, attended all the classes, and then became a teacher at Golden Gate University himself. And so we're very fortunate because Ramon has taught, I would say, hundreds, possibly thousands of students. And the demonstration, Ramon, of how good a teacher you are is how good your students are. And so we do these Wyckoff method discussions every week, and we have many students that have come through your educational programs. And the quality of the work that they submit week after week is just exceptional. And this is really a testament to you, Ramon. And in addition to that, Ramon is a very skilled trader. He's a magnificent tactician and strategist in the markets. We see that every week in the Wyckoff market discussions. And I'm sure that in all the classes that you teach, that your students are just, you know, in awe of your ability to be able to systematically and with great nuance be able to study these markets. And with that, I know I've left a lot out and I could say a lot more, but Ramon, we want to give you the time so that you can make your presentation. The only thing I want to say is that I don't have access to the questions at the end, so that I can see how to access them. So we may have to have you go through the questions and we can go over them when that time comes. But anyway, so everyone, welcome to Ramon, and thank you so much for organizing this wonderful day.
Well, Bruce, thank you so much. If I would have known you're going to say all of this, I would have introduced myself, because I feel like, wow, is that all me? I mean, like, coming from you, it means really a lot. You know, coming from the community, it means a lot. It means a lot to me that we're all here, that we're all together at these times. So, you know, I'm really grateful, Bruce. Thank you so much. And Bruce mentioned Hank Pruden, you know, our mentor and teacher, you know, who passed away a couple of years ago, and we dearly miss him. And indeed, you know, all of the educational teaching methods, you know, we've got from Hank. So, you know, Bruce and I, you know, I consider us kind of like the heroes of Hank, and you know, we have something from him. So if you want to still be touched by his presence, you know, come to us, and you know, we will have that in our classes. Thank you, Bruce, again. All right, I'm gonna go really fast because you know, we're a little bit off track. So really quickly, this is a free event, but more free events are coming your way. We want to make sure that you guys are staying informed about, you know, our offerings and the markets. We analyze the markets in each class. So on April 20th, 21st, 22nd, we're going to have free webinars, different classes. Also check out some, you know, wonderful blogs from wonderful contributors that we have on our website. Bruce is publishing the Wyckoff Power Charting, so we have all of the links, you know, to stock charts. Alessio is just phenomenal in the crypto analysis, and he uses Wyckoff for that. He publishes a weekly crypto report, and it's just wonderful. John has just started the class yesterday on scanning. That's part 2, and his blog is just phenomenal, you know, and he is becoming such a great teacher and contributor to Wyckoff Analytics. Franz is talking about and you know, making diaries of his trading mistakes, and together we are doing the anatomy of the trade that we publish on YouTube. So check this out. All right, so another announcement is we just started the communal Wyckoff watch list. This is something that we've talked with Bruce for some time, and finally, you know, we've come together and we decided we're going to involve the community. This is not going to be just the list from us. All of our students are going to work on this list, and they're going to submit the list on the weekly basis on each Friday by 1 p.m. Pacific and send us their top 20 candidates of large and mid cap stocks. And then Bruce and I are going to go through them and create the final list. So if you want to participate, get more details from us on the website or go to stock charts. We already have that on, and you could see different steps here. Go to charts and tools, public chart lists, and then you will find our chart list. All right, so where did it all start? I really like to study the markets from the historical perspective. So I'm going to give you kind of like a historical perspective, short-term perspective of where we were, what was the thinking, and what were the trades. We were heavily bullish off this low in 2018 going into January. And, the analog that I've been using at the time was the analog from 1990. 98, 99 going into the climactic top in NASDAQ. That structure really resembled what we went through. On the PNF counts, and Bruce went through some of the details on how to make those counts on the PNF charts. We had the original count that indicated 35.25. We had a confirming count, and this was all in real time, so in October 12th, 3,500 as well. We went, I believe, to 34. As we go to 34, this is NASDAQ Futures Daily. There was something very interesting at the beginning of the move down. Suddenly, the volume signature increased relative basically to everything what we've seen since the low. And that was the call here. My expectation here, and Bruce was talking about the deterioration of the conditions on the way up. My expectation here was that we are going to have a cyclical decline. And I was trading it exactly like that, meaning that I had positions on, and unfortunately I had, I closed positions at the first low. That was kind of my understanding at that time. And I always share honestly with you, what was my thinking, what were my mistakes. This is just the way for me to figure out, how I can personally improve. So what did we see in this picture? Again, I mentioned the volume signature, and also the price started to move a little bit better to the downside. There was more ease of movement than on the prior reactions. And then in the deeply overbought condition with shortening of the thrust, overthrow, it made sense to make that call as the change of behavior was coming in. And here's the result. Look at that. I'm comparing here different markets where velocity of the price was significant. So in comparison, 1987, if we would take the distance that the price has traveled down, 35%, 36% in 39 days, and I'm taking the highest high with the test, highest high with the test, highest high with the test, highest high with the test that was much lower and much weaker, and kind of showed and gave us a little bit of a tip on the character that's going to come next. So look at the velocity, minus 9.2% per average per day on the way down at 87. Obviously here velocity was much quicker. In 2000, we have a very comparable velocity to the downside, and actually this was a very good analog because in 26 days, NASDAQ has lost 37%, kind of reminiscent of what we've had just recently. In 2011, there are a lot of references, or there were a lot of references at that time of movement. Velocity was also pretty high, on par with 1987. So that's what was so unusual about the tape and how it moved and how the structure, has been created. Usually when we have that type of volatility, and this was the highest volatility in the shortest period of time that we've seen, considering how much ground has been covered. 87 comes out as one of the spots in the structure in the markets where volatility was as high. So I always want to refer to the analog structurally, understanding what was the biggest technical catalyst of this decline. And to me, it's the volatility and momentum to the downside. So in 1987, we still had quite a lot of volatility in the initial testing period, in the conditions that were defined as extreme oversold and extreme value. So what did we have here? Move up, move up, test again. And after this test, we had a move up, which was not significantly higher above the high. We came to the value zone and we accumulated there. We were diminishing and unwinding volatility and momentum. And with such increase in volatility, it's my kind of like idea that we're gonna start unwinding that volatility for some time. It could take a form, structural form of a trading range. We could have a more complex structure where we could have, multiple structures like this. We could also have tilting down type of structures, sloping down type of structures, but one way or another, that volatility has to unwind and it has to go away. And the biggest question that I'm being asked is, what do you think about the markets? Is this the low? Are we going up or are we continuing going down? I think if you approach this from the volatility point of view, you probably will see that we are in the trading range. And here are different instruments that I'm showing to you guys here. Look at the S&P. We had a climactic low. We have an automatic rally. We're probably in the secondary test type of movement to the downside. We need to assess what kind of character of the move to the downside we're going to have relative to the previous move. And whatever we had here in terms of the volatility will not be compared to this. We already have enough liquidity in the market. We already had some buying by big institutional types into the selling climax. So supply is more exhausted at this point, and that could influence the character with which the price moves in the secondary test. Bitcoin, this bar right here is the most important bar that we could potentially see on this chart. And we still have to overcome this high, and this intermediate resistance is providing, some hardship for the price to move even higher. So I'm expecting that we're probably going to be in this area for some time unless there is active demand that could break us out of this formation really quickly. So that's going to be very interesting to observe. Crude oil, a lot of capitulations on the way down and quite a very weak structure, obviously with a couple of days that we've had off the bottom, which seems to be more short covering on the news rather than anything else. To me, that still is suggestive that we are in the trading range, some supply is coming in at this point, or we are in the larger trading range. And again, that volatility that we've seen in oil should unwind at some point. Oil is probably one of those instruments and assets that I still would think that volatility will be present. And this is a very interesting market from day trading point of view. Look at the TLT, 20-year-old Treasury bond. Again, we are bound by the support and the resistance. And we know how trading ranges are created structurally and characteristically. We usually will have a stop in action buying climax. We then will have a change of behavior that is going to show different attributes, different characteristics to the tape with which the price moves down, this increase in spread, increase in volume signature, presence of the supply. That's going to create that change of behavior reaction into the automatic reaction and then a secondary test. So we're here. We're not going anywhere for some time. Gold has the same characteristics, and gold was interesting as well as the TLT because this was a source of funding. They were selling everything into the capitulation. That in itself defined the low when that capitulation happens in different assets. They're selling to raise cash, to meet margin calls, and just to be in cash to get out of that volatility. So it was a very interesting spot to observe into the capitulation of the market. And this aggressive rally into 1700, look at the result of it. It still does not produce any commitments above the resistance point and goes down. So I would say that we're probably in this area for some time, unless we see some kind of more further commitment to the upside. Volatility itself, VIX on S&P 500. Whenever we have a substantial increase in volatility, it doesn't mean that volatility is going to go down in the same way quickly. It usually takes time to unwind that volatility. So my expectation here is that we're going to do something like this before we go down. This period could be much shorter, especially if the analog that Bruce brought up, 1962, will work out in a quick way. And then this is a typical stock formation that I see right now in the markets for those stocks like cruises, hotels, tourism, energy, financials, you name it. There is a big quick decline and then a stop in action, and then a bounce up usually would come to about 38%, 50%, whatever you're using as your fibs or any other numbers. That usually shows, again, a change of behavior in a different way, in a different direction. And that defines our boundaries for the trading range, resistance and support. So this type of stocks, and I was just going through the whole list, the whole market yesterday, and just was looking at the charts. This type of formation suggests that it requires some time to create a cause. We can't really buy here for the long term with an idea that from here it's going to go and bounce up back into the same level of the resistance. The companies need to restructure their behaviors in the market relative to the consumer behaviors, and our consumer behaviors have changed. We are not going to the stores willingly now. We are sitting more at home, and once it's all done, there will be the first attempt to go out and participate, be together. But at the same time, my belief is that consumer behavior was disrupted, and therefore the companies, I'm looking only at the charts of the companies that are benefiting right now from this environment, because they are becoming more of the defensive play. All right, let's look at the very long-term picture. Bruce has shown you, I believe, yearly charts. This is a monthly chart of Dow Jones Industrial. I want you to look at the bullish recoveries from sharp reactions throughout all of the cycles. Look here in 46. It took some time for that sharp reaction to unwind the volatility, create the reaccumulation range, and then move up. In 57, we had a spring-like situation, and from there we had a quick move up, but we already had a build-up cause. 62 analog that Bruce uses had that quick recovery. Again, there was already a causality built into that. Let's look at 87, probably one of my favorite analogs, to the volatility that we have had. Look at the decline relative to the secular trend. We're going from one resistance point to the next support point, and we're going there really fast. So kind of reminds me of what have happened just recently. And we're seeing how support is being respected, and it takes time to build the cause, to move to the same level where we come from, and then to, again, test the supply at this level and then move up. 98, Russian default, had a big recovery, but was more later in the cycle, in the secular cycle. And we have obviously 2011, 2015, 16, and now 2018 and 2020 as those big sharp reactions. Please note, we are still in a secular uptrend. We have not broken that uptrend whatsoever. So the biggest bearish question for me is, would we be able to go down and retouch the support like we did in 2008, 2009, in 87, and so on and so forth. Going to the monthly, what are some of the pointers here? Well, it's very interesting how the uptrend develops. Structurally, we should have some kind of significant momentum kickoff that would put us into sustainable uptrend. Whenever we are experiencing a top, we will experience a change of behavior that will violate that uptrend, and then we'll have some attempts to go up and then drop down. So very interestingly, we are at that stop. We are probably somewhere here. Look at how these lines are working out, and definitely a change of behavior after sustainable uptrend that started with the momentum kickoff. And we could see that if we're going to consolidate here, to me, that is still going to be under the question. Are we going to break to the downside? Are more bad news going to, put the market under pressure, and we're going to go into a deep recession or maybe even a depression? That all is going to depend on how the news cycle is going to unfold and how market participants, especially institutional market participants, are going to react to that cycle. So I'm not really making any predictions. What I'm trying to do is just to figure out different scenarios. So for the bullish scenario, I would love to see the price staying at this level and actually coming slightly above the low in 2018, February low, and that would show me that there is some strength. If it's going to be a much weaker structure, closer to this support, that probably would put me into thinking that we might actually have another attempt to go down. And the worst case scenario, bearish targets, and I usually would like to see this on my charts, is going to be a resistance that has been formed by these two major tops in the trading range that is between 2000 and 2008, 2009. We should do, together with Bruce, the PNF for this whole area and just to see where it's going to take us. If you think in terms of Wyckoff structure and you kind of distance yourself from the monthly time frame here, and you think in trading range, then this could act as a major sign of strength, and then we could be in some kind of backing up action that could potentially either have a prolonged consolidation or have a move up and then have a consolidation, or even go down and still have attempts to go up after that. On the weekly, what's interesting, and Bruce talked about this, the same type of the extreme velocity in 2008 that we have seen just recently suggests that that momentum to the downside could have a sloping down testing period. And if we have that sloping down testing period, we could have something like this, where we are respecting the support that comes from the expanding triangle, and I've seen quite a lot of work on this, so that's an interesting thought. And then as we're testing into this low, hitting 2000, a rebound from here could be, quite rapid, just because of the nature of how this type of formations unfold. And obviously, again, for the bullish scenario, we want the price to go up and be above 26 and then go higher from here. So this is the scenarios that I look at. Look at the immense increase of volatility, which is measured by the average true range. It was just phenomenal. And for comparative purposes, I'm showing you here 2018 increase of the average true range. It's just basically a measure of velocity. And we could see that in 2018, yes, we're going up, but we're not accelerating at the same rate. We are actually stopping and then accelerating further. Whereas in 2020, for 22 straight days, we were accelerating the velocity. And it was just amazing. And that's why this market is so unique. If you would be thinking about tape trading, and if you would be thinking how we would trade this, so our call was here. I actually had quite a large position here, which I actually closed and then reopened, with lesser size. So, and that's kind of like was one of the mistakes. My exit was at this point. Again, remember, my thinking at the time was that we're experiencing a cyclical low. So now I'm thinking, what kind of mistakes did I make? You know, technical, analytical mistakes. I think that this volume signature was much higher, and it's going to be more evident from the next slide. And then the character with which the price moved, consistency of the decline and the increase of the velocity and increase of the spread should have suggested to me more that we could have more of the continuation rather than a cyclical low. Once we broke to the downside, that has become more obvious, and it has become more obvious that the best trading strategy at that time was actually day trading, coming in you know, into each day and basically taking it day by day. And that's what I've been doing this whole time and even now. All right, well, what are the worst case scenarios again? To the downside, this is an alternative price structural view. If we break to the downside here, and my comments, my most recent comments on tape reading, 2400 is a very important level. We definitely need to hold here if we're bullish, but you know, we've seen some supply coming in just recently, and demand has become very complacent. It's not that supply was very present in this area. It's just it wasn't that aggressive. And on the background of the complacency of the demand, the price started to go down. The key now is in this 2525 and 2400 resistance support area. Supply comes in and there is no progress to the upside. Supply comes in and there is no progress to the upside. That's effort versus result. And you know, as we notice this, we would be expecting a continuation down. And if we break 2400, well, we could have different scenarios here. We could go and create a higher low. We could go and create the low that would be at the same level as 2175 that we've already had. And then we could have a much more significant correction, especially on more bad news. I keep repeating that. And it could be a significant decline from this low. From this low, we could have another, 20+%. Please also look at this. If we are going to break 24, what would structurally happen? A couple of very significant things. Well, first of all, just the break itself is going to be significant, and we're thinking that we could trade to the downside here. There's going to be some kind of increase of velocity, maybe not the same as we had before. But this would also mean that we still would stay in the downtrend, and that's very significant. We would still be making lower highs and lower lows. Again, for that, we need to break 2400. We also, in this downtrend, twice retraced the moves to the downside by 50%. So we know exactly what needs to happen for us if we go down to change this behavior. We need to have the rally that would overcome the resistance, the downsloping resistance in the downtrend, and have different type of characteristic and different type of retracement that is going to be more than 50%. For the bullish case, I really like this, ice cream story where volume is diminishing and we still have lower lows, lower lows, lower lows. Bruce was going through this, so I'm going to give you guys a little bit of the tape reading perspective here. As we go into the climactic action, we have a lot of institutions that are seeing value, they are stepping in, they are originating their positions. They only buy at the lows. They do not buy on the way up. They buy at the lows, and that supports the price for some time. Speculators coming in and pushing the price a little bit higher. But then because institutions step out, and the price comes back and retest, comes back and retest, comes back and retest. And we see this at multiple points of interest where institutions are coming in at the points of value, supporting the price for some time, allowing the price to rally, but not continuing with their buys there. So in a way, we kind of saw it here. Our first comments on the buying, institutional buying, actually came on the preliminary support, and then into the national emergency reaction up, into phase B, retesting, and then finally this day right here, the 23rd, changed the behavior and showed some bullish characteristics. This was a really good call and a really good trade. Also, this day, for the naked eye, probably not that visible, but for the tape reader, this was probably the first normal day when volatility diminished to the point that we could say it was quote unquote normal session. And from this session on, already kind of knew that we're going to have smaller volatility. And I think that at this point, just all of this liquidity that was pumped into the market actually starting to work, actually started getting to the final consumer, who's going to use that liquidity. So what do we need to see here in this decreased volume characteristics where institutions buy in early on and then just supply is being exhausted and that carries the price up? Well, we need that support at 2400, and that's why it's so important. Otherwise, if it's broken, we might retest or we might go even lower. So we need to have the structure that has higher highs, higher lows. All right, and this is it for my presentation. Just want to mention a couple of other things. Go to our website. Franz is leading the Wyckoff Analytic forums. You could submit your charts. You could, have his explanation or input on what you guys are doing. A lot of you have mentioned our YouTube channel. Please go check this. We are publishing Bruce's videos there as well, Anatomy of the Trade, and there are quite a lot of educational material. And almost each day we have some kind of commentary at Wyckoff Analysis handle on Twitter. So you are welcome to check this out. And with that, thank you so much, guys. I'm going to take maybe a couple of questions and we're going to move to the next presenter. We're a little bit behind. Mahmoud is asking, why volatility should unwind before the market moves? Think about institutional investors. It's extremely important for them to correlate volatility with the potential returns on their portfolios. So their preference is to come into the environment, into the buying environment when volatility is actually low, not high. So therefore, I see a lot of waiting game by institutional types to weather this volatility down and then to step in. Once they are stepping in, when volatility goes down, that's when we're going to have a much, much better support in the market than the occasional value buys that we have at the present. All right, guys. Is the velocity average per day, is that your calculation indicator? Can you say more about this from Senit? Yeah, I just basically calculated this on the, by the calculator with the calculator, and just took a very simple, physics formula of the distance that equals time and the velocity, so we could calculate the average velocity per day. And this is obviously not very scientific, but for the tape reading purposes, I want to keep that on the back of my mind because it was just so extraordinary. All right, great, guys. Let's go to our next presenter, and it is my pleasure to present Gary Fullett, because Gary and I, we had a lot of time together in different classes. I think that we taught maybe 3 or 4 series together. Gary is such a wonderful community member in Wyckoff Nation. He is devoted teacher. He is devoted tape reader. He is just a very nice guy, extremely funny. Every time that I talk to Gary, he just puts a smile on my face, and on the top of that, a very deep thinker about tape reading, a very skilled tape reader, and I can't wait to see what Gary has for us today. Hi, Gary. How you doing?
I'm well, thank you. Thank you. Thank you. I would say that, the panel that they put together today is, I know Gary Dayton, Dr. Gary, and I spoke with David and I, and back when David and I did webinars, David Weiss and I did webinars. And he's really a fantastic person. And really is somebody that I learned a lot from. Bruce, I think the world of you guys and what you guys were doing is unbelievable. And obviously, David Weiss. So this is unique because you have in my mind, the best of the best that are here. And I think that is something that is unique because it binds us all together. It's really great. It's really great.
Well, thank
So
you,
I really
Gary. And
appreciate being.
let's switch the screen to you now.
Okay. Hopefully everyone can see my screen.
Not yet, Gary, not yet.
Okay.
Yes, now we can see your screen. Great.
Perfect. So great. So would you like to begin then? And we could begin if that's the case. Okay. So hi everybody. Again, it's really a pleasure to be here. It's an honor to be with Roman and Bruce. To me, you won't get any finer Wyckoff material there is, and especially with the other as well, Dr. Gary and David. Those guys are the top of the top, and I'm just the cleanup hitter. So I mean not cleanup, the on deck person for these people. These guys are top. I want to approach something a little bit different. My approach is a little bit different in Wyckoff, and I started out teaching and I taught structure as far as buying climax, selling climaxes, in those nature. And and I started doing that, I think I was the first one online to do that in '95 with AOL chat room. I still do a day chat room, but I've gotten away more from the classical Wyckoff patterns of buying climax, selling climax, and things of that nature. I'm a very big believer in spreads. Rome and I have talked, and one day I'm going to do a talk with them on spreads and the NASDAQ, S&P, and Russell, which is really a fascinating talk. We'll get there one day. But more importantly, we don't see the buying and selling climaxes like we do, but we look at them sometimes in hindsight. And a lot of Wyckoff stuff is hindsight, but because there's some actions that lead to the next action. Having said that, volume and price are the only two indicators that are alive. So everything else you see is a lag indicator, RSI, and things of that nature. That's why Wyckoff, to me, is the best. It's the best indicator because of that reasoning. Okay, so I am not going to repeat Roman. I'm not going to repeat Bruce, Dr. Gary, because you know what? You know the areas and points. You know the areas and points that go on. So I want to add something different to this group today. Okay, as you know, the market, the Russell index, has more stocks than any of the indexes. We have the Dow 30, S&P 500, with the NASDAQ 100 1000, and the Russell. So to get a broad situation of the market, the Russell is the one that tells you more of the breadth of the markets. It's very critical. And the Russell weakness, I wrote my newsletter, the Russell weakness always to me was something that was a telling sign that ultimately that we would fail. Now, I'll tell you something interesting, you're probably shocked. I was a Ford trader at the Merck, and I was in the 487. And the market started to break. The market was down like 10 points. At that time, the Dow moved around 20 points a day. 20 points a day. This particular day, the volatility picked up beforehand. The market then broke, and they made a flippant comment to a Japanese reporter that's on the floor, said, "Oh, we could be down 500 points today." It's a joke. The next day, when the market was down 500 points, I was interviewed. And I said, I was joking. I didn't mean it, but it just felt heavy. Why did I bring that up? That day, at the end of the day, people, brokerage firms started taking out money. There was a run on the banks. There was a situation in which people freaked. Unfortunately, people jumped out of windows. Unfortunately, people got to the point in which it was horrible. The breakthrough we see now, the panic we see now, is nowhere near what happened in '87. It's hard to believe. But every breakthrough we had in the past was fixable. lowering interest rates, adding liquidity to the markets. So that is something that's very important. So as far as it goes, I'm going to do something a little bit different today. I'm not going to go over numbers, but I'm going to tell you how this week was manifested in itself. Okay? Here we go. I'd like to add something unique to Roman's group because I love this group. I think it's fantastic. So obviously we start with larger time frames, okay? But let's just talk about the market in general, just real quickly. So obviously, I don't know if you look at a monthly chart, we look at a monthly chart and I work from a higher time frame to lower time frame. If you look at the market this way, this could just be a spring of the market, right? Okay. Or this could be preliminary supply and a buying climax. But when you look at the monthly chart, bad as it seems, could be. Having said that, I'm really negative overall the market, but I think we go back halfway back. I think Dr. Gary mentioned the 2830 area, which, and I'll show you that as well too. But I don't want to go over what they said. I want to add something different to this group. So this is on the monthly chart. We go to the weekly chart, obviously. We see something different. We see a market, and this is very interesting. Bruce mentioned this, and I was in it for all the thing, but we have this market. With Wyckoff, we just don't draw one line. We draw reverse trend lines. We take our parallel channel, and voila, we get here. Great channel. I'm worried about when the market's rallying, I'm more worried about the upside than the downside because we don't use this as demand and supply. We use our horizontal lines, but we use it as a reverse trend line. When this market becomes more overbought, we do not consider this consider a breakout. We consider that a more overbought line, more danger zone. So if you have a point and figure of 30 of a stock and the stock goes to 36, as much as that stock is more bullish because it's higher, it's also more overbought on the point and figure chart and can come down. Obviously, Wyckoff used point and figure chart very nicely, and that's one of the ways we get our count from point and figure and reverse trend lines. So a point and figure chart that's overbought and the market that's over the sign wise is a danger area, not a breakout. Obviously, Bruce is one of the best in the business point and figure chart, so I bow my cap to him. So I'm going to show you change of behavior. So we talk about reaction highs and reaction lows. In this chart, Wyckoff, we believe in Wyckoff that price action incorporates the fundamentals of the market. In this case, the market failed to do that. It's unusual. There was no Wyckoff behavior of a buying climax here. In order to have a buying climax for Wyckoff, we need to see preliminary supply and a buying climax. So I know we look at structure, and as I told you, I look at structure differently. There is no preliminary supply here, none. Okay, this market. Point and figure chart by Bruce was perfect. Okay, but there's no, because of buying climax, the widest range, largest volume. We don't see that. This is horizontal. This is vertical absorption. These little breaks are shakeouts. One of these breaks was the Iranian thing, then the missile, then the killing of the guy. We heard about this virus in January. The market then proceeded to break. This was January 27th. It was the week that President Trump made the last not that big of a deal, not that big of a deal. But the market sensed something was happening. But the market did not look at that as anything important. Now, if you want to say it's preliminary supply, it was different because the range was not that wide now, relatively speaking, but it was a relatively wide week considering, but not anything that would be anything greater than these breakouts here. Anytime a market breaks, people say, pop, pop, pop. And then the market, preliminary supply, the market's sharply higher. So eventually, you're going to get a score's going to find an acorn. Once in a while, you're going to do that. The Joe Granvilles, the Abby Cohns, all have these great one-time things. They're great people, but that's what happened. Market went new highs. As probably Dave will mention to you, the market went up here, a good bar. Then we're going to go short the upward thrust. Upside movements. Not a big deal because you wouldn't say this is a bearish bar. But here's what's key about this whole chart. And I'll show you more clearly in the chart. This market has right here has we mark high volume areas, and David is phenomenal at this. This area here, we mark areas with stopping action or markup areas. I mark this bar right here across. Once this market started to break an increasing volume in price range, we have two things. We have a shakeout, or we have this area's distribution. We assume shakeout initially until we see the reaction of the market. I mark this area. In a shakeout fashion, it acts as a spring of the market. It acts as a spring to the market. This obviously is not in the spring position. We break, market breaks back down, but does the market have light volume here? The light volume here is because the longs are already washed out. The early longs get washed out here because the last longs are the first ones to get out. And the market continues to break. We see a supply, I call this a selling tail, a market that goes up that breaks. So I teach this in my mentoring thing that I do. So the market that goes back, it's a selling tail to the market. Since it's not a shakeout, it's an area that's weakness. Market breaks. So mid-range close, real good close. That's kind of a shakeout. That's a great close, great volume. Shakeout, we're going here. The problem is this was not an area of a spring type of formation area to Wyckoff. It was more of the weakness in the market. So this buying of the market was the composite operator buying back when he sold to the funds and specs. When the funds and specs buy, they buy new highs. They buy new highs. They sell new lows. They're momentum traders. The composite operator, like a Warren Buffett, let's say, in the market-wise, he'll buy a stock at 30. He won't pay 38 for the stock. He'll wait to buy back to 30 and buy his shares. If the market goes above 38 and then goes to 40, what does he do? What does the market do? Either he caps it if he thinks it's overvalued, and if he does not cap it, the funds and specs buy it. That's why you see increasing volume when markets make lower lows. This is why, and probably Dave will explain it to you more, this is why springs and up thrusts are so effective in markets. It traps the transfer risk. We then break. This becomes our reaction. We don't really mark this in the sense of a buying bar because the market really didn't buy, but we'll mark it here. You come off the low, breaks. This area here, I'll show you the NASDAQ a little bit, is somewhat of a labored break to the market. The market's making new lows, but not excessively to the market. So I don't want to spend a lot of time with this chart, which I did, but I want to go to a different chart, the daily, because most of you don't look at weekly charts in the S&P, for example. Again, we have our overbought line. I'm going fast because I want to get this done. These are shakeouts. These are shakeouts. No follow through to the market. Extremely important to understand what they are. Market takes this area here. We draw a line across, and we start to get a point in which the market now has an overbought line. This is where my discussion really begins in earnest. We have a market shake out new highs. One of the things, and Roman has told you, I listen to Roman, springs have to make new highs. If springs do not make new highs, that means that they're making a lower high, and eventually they'll make a lower low. This market does, spring-wise done. We know the springs can have a one-bar spring, a spring of a previous bar, or we can do that as a ice support bar. Look here, the market is overbought. This does not give us the right to sell the market short because there's no distribution. A market that hovers this reverse trend line stays very bullish. Look what happens. The market starts to pull away. The slope we're pulling away from this line. It's becoming less overbought, but a little bit negative because the market cannot keep up with the slope of the rally. So this bar right here was a very key bar to people. This was a bar that even though the volume was a little bit was not that the script here, but it's where the market started to mark up from. It was a spring of the markets. This spring made a new high. Very good. This bar right here is a very good bar, or potentially a good bar, because it sprung the market here, another spring. Okay? what does that spring have to do to the markets? It has to make a new high. Otherwise, if no new high, what happens? Down. No new high, down. This market then comes here. This was the line of the sand. This market had to react. Otherwise, all these longs start to liquidate. This was Friday close. They started to sneak down prices. Not so bearish, but the market has to make a new high. Remember, I talked about springs. Have to make a new high. This was the gap. You make your decision. Is that a spring gap, to buy the spring? Or is that a gap in which it's weakness? Well, obviously, I don't think anybody, Wyckoff-wise, would buy this. This just told you, flip over all the cards. You know what's happening. You know that this area, being accumulation, is now distribution. The game is over by this one bar. This bar takes out this bar right here as well, and the game is over. Now, Wyckoff looked for secondary tests, but the market was in the ready position. So, since we had distribution here, this became a foregone conclusion that the process was going to begin in earnest. The news was not that bearish up here, because we don't top out unnecessarily bearish because the market was higher. But as the market started to mark down, we started to get the news about the virus. But the market here, we knew about it in January. The market did not top out until February 20th. So I mentioned to you the market was lagging behind. This is unusual for the market. You usually see this foresight, but I'll explain to you how we can tell how the market broke from another market. This market then broke. Okay? Once this market here, we got to make a decision. When I was trading for, they would say, Gary, what do you think of the market? If I would say, I think we're going higher or lower, get out. I have to have a good conviction. So the question is, if you were long and the market did this, would you put that long position on? The answer is no. So the market has the opposite effect to the market. Again, as Roman has mentioned, after result, I'm very big on after result. Obviously, this increasing volume, small range, is stopping volume temporarily. It's where the composite effort buys back his shorts that he sold. He buys it back with a huge profit. The market is weak in position. I look for an up thrust right here. If I get short, my stop above here. Market break. You start to move down, down, down. Area-wise, this market here is the reverse trend line to the market. And what do we see? We have to see that the losses are not as prevalent as far as wide bar action. I have a thinking when I looked at trading for, when I see high range or low range, low close, high close, low close, there's a battle going on, change of behavior. This market should have got ran big time. The market went down in light volume, or not light volume, but not heavy volume. The longs are out. Created this rally. Okay, it's extremely, extremely, extremely important to the markets. Extremely important to the markets. Now, as this is the left-hand side of the market, phase A, and now we're getting to this more second phase. I call it the right-hand side. We should see less volatility, even though we're going to have volatile days, but less volume because the market's not above resistance areas or under support areas, so we'll stay there. If you look at 3,400 as our high, you take 2174 as your low, it comes right around 2,800, so about halfway back. Okay. If we don't look at one number with Wyckoff, we look at areas. Here to here, this area is where we look for retests, and I think we're halfway back. Okay. So that is that. Now, I don't know how much time I have, but I want to go over the Russell with you real quickly, and I want to show you something. Hopefully one time with Roman we'll do this. I believe the NASDAQ leads the S&P, either up or down. NASDAQ is a market that's more speculative in nature. And that way, when people feel good about the market, it leads with the NASDAQ markets. This market is obviously very vertical. Vertical markets end very badly. .com, 2018 December, they act badly. You say, well, Gary, where's the distribution cause? Because this market is such a fervor upside to the markets, okay, such a fervent upside, it breaks back down to find value. So now this market was very, very bullish. And remember, February 20th was the high in the market? This spread leads. This high was 14th. It started heading down. Usually the spread's about 2-3 days in advance. Okay? And now we're in this trading range, market-wise, nothing going on. I watch it. So, very important, that leads. Let's do the S&P. Let's go through this real quickly. And I'm going to show you something great. Let's just start with our NASDAQ. Okay? NASDAQ, if I can have better things. The NASDAQ here, obviously, is vertical. If you want to say this is if you want to say this is a preliminary supply buying climax, okay, then everything you see here is that region. So you only tell the buying climaxes afterwards, okay? This is the reaction high, reaction low before the high. The reaction low before the high. Wyckoff describes this, or retest of breaking the ice. The market then gets this point. This is a perfect sell to Wyckoff. This is so classical Wyckoff that I can't even imagine that. Okay, this is weakness. That begets weakness. Perfect test, not a shakeout. The volume increases high here because the last longest get stopped out. It doesn't get any more perfect than this. Where's your sell? If you want here, you can sell the breaking of the ice. If you're a little more conservative, right, you can wait. You can say here, but your stop loss has to be above here. Wide stop loss, I agree. Okay, or you wait for your secondary test. But the wheels are in motion. The campaign is in motion to go lower. Okay. Also, NASDAQ squeezed a little bit down. Shortening of the downward thrust led to this rally trading range. So this market really had the big run up. So keep this chart in focus in your head. Okay. We then get to the point in the S&P, the second of the two markets. If it's very hard to imagine that we talk about the S&P, but the NASDAQ strength was higher to the market. NASDAQ's higher strength to the markets. So, real quickly, we took out this December 18th. I'll show you about strength and weaknesses. December 18th low. So the market's in a quote-unquote spring position, but really from weakness, so that's not really that great. December 18th low. Okay, remember that, December 21. Let's go back to the NASDAQ. Okay. Let's go back to the NASDAQ. I'm talking about strength and weakness of markets, how you can tell if this market was weak. This market, where's December 8? Where's December this chart? Here it is. Which market is stronger? This market only took out last year's low, the 19th. This is where the same spring that came in the NASDAQ, S&P, look how far we are in the NASDAQ. I'm bearish overall, but this shows the strength of the NASDAQ, right? Still. Now, this is the NASDAQ. Real carefully now. Look at my Russell Index. Russell Index was classical Wyckoff. When I was on the trading floor, I met a guy that owned an island, and he would only trade markets that were obscure. And he would tell me that he's not going to know as much in the S&P as Bill Gates or whatever these guys. But if he can go to a market that's a little more obscure, he can understand it just as well as all of them. So look at the structure of the Russell. It's so perfect. And sometimes we get perfect Wyckoff, and sometimes we just have to read the tape because we don't see the exact Wyckoff. So here the Russell Index gets to the point. I'm making you dizzy. I'm sorry. Here the Russell gets to the point where the market makes the high. This is that December 18th. This is that. I'm sorry. This is the 18th low. Here. Remember, the NASDAQ never went to this low. The S&P had a spring of this low. Look at the Russell. The Russell is the secondary stocks that are more breadth of market. and yet they destroy the Russell index. That shows you the bearishness of the markets. The one that's speculative also, that feeds into the NASDAQ products, getting hammered. So you have to look at that. Now, when the market was making new highs, right? The Russell and the S&P, NASDAQ and the S&P were making new highs. This market, I pointed out in my newsletter, this market never made new highs. This market maintained the weakness in the market. This was perfection. So if you want to look, so again, Wyckoff schematic wise, normally you'll say this would be preliminary supply, but then the buying climax would make a new high. This to me was the buying climax because the market was weaker, even though I'm not considering a buying climax, but in my head, it's a weaker market because we didn't make new highs. This was the sign of weakness. Preliminary. Now I don't label things like that all the time, but in my head, weakness, buying climax, boom. So the Russell was actually the weakest one all the way through this whole process. Eventually, markets that keep going up vertically will break. When the market breaks eventually in shakeouts, they're in an acute situation. Bad earnings, the president trips, he broke his leg, whatever. Those are acute situations, market goes back. When you have a chronic situation, like you have now, this is where you tend to have trends that continue to occur. This was weak all the way through. This was all distribution to the market because the market never took out that high. Remember, springs have to make new highs. I'm very big, boom, that way. So that is so critically important. The Russell, now not many people watch it. I'm going to assume that you're all going to watch it now, hopefully, but it's so critical in your analysis. Okay. Now, that's
Gary?
really important. I'm trying to go fast, trying to get a lot in. Yes.
Yeah, Gary, just a gentle reminder, about 5 minutes left.
Okay. I could do 18 charts. Okay, hold on. Okay. So let me show you another reason why the market broke. Gold is a flight to heaven, flight to haven when things happen. Okay. Well, remember when the market started to go up and the market was making new highs in February. Well, something happened on the road to the market. The gold market started to accumulate in November. This gold market rallied. Gold knew something. Now you can look at that as far as that goes. Okay. But the problem becomes, is that not the problem? The market sniffed something here. Sometimes markets sniff something. We don't know what the event is, but the markets have a good way of knowing it. So from an S&P standpoint, no, but from a metal standpoint, this market already started to move up. Okay. When the time February 20th came, the market was right here. The market anticipated, why did gold rally? Everyone's looking at, I remember people asking me, why did gold rally? I said, there's something out there. Gold was the first thing to react on 9/11. Gold is one of the quickest. If you see gold moving, it's something is happening with gold. I don't know why, but it just so happens that gold seems to lead. Another market that leads is the bond market. When did the bond markets go interest rates? So when there's a flight to quality, they go into the bonds because they're guaranteed by the government. Okay. Well, look what happened to the bond market. When did the bonds start to base and accumulate? That's interesting. The bond market started in 2000, and this year forms went up a trading range. The market was already moving up in January, like the quality into bonds. My point is, if you look at all the markets combined, you will see that you just have to look around other markets. You saw chinks in the armor to the market. You saw the market acting very differently. So to me, bonds and the gold will tend to lead the indexes many times. Gold, for some reason, is a situation in which gold gets to the point in which we lead markets because maybe it's a situation where that lead of the markets where it's easier to move gold around than it's to move 500 S&P stocks around. So I didn't go a lot in technical analysis, even though I did drawing away and where the market actually broke out from, because there was a change of behavior on that Sunday night. But more importantly, I want to show you why the market broke and how you can tell clues to the market. Now, does it always work that way? No, and everything is different. This break is much different than everything else, but you could see signs if you're very observant in Wyckoff structure, in Wyckoff behavior, that the overbought line became coming off the line. And the market also got to the point to where we saw the Russell being weaker. So there was a lot of clues to the market that allowed that to happen. Okay, which allowed that to happen. So I took up enough of your time. And David and Dr. Gary and Roman and Bruce obviously do the heavy technical lifting. I do as well, but to make this even better, more enhanced for everybody, I wanted to see the situation. I want to see the situation in which I wanted to show you more of a understanding of the weakness of markets that led to the break. Having said that, I think the market goes into a trading range. I think that we have more volatility on days. I think I like Bruce's area that he mentioned about 18,000 in the Dow. I think that's very doable. I think the halfway point between 2775 is something that's also something that's very, very important. Roman, if I can have 2 more minutes, I want to show one more chart.
Absolutely,
Okay?
yes, go for it.
Guys, you're going to be fast. So you're going to have to put another $1 in the jukebox, everybody, to get this information.
Mm-hmm.
So I'm going to double your pay. I'm going to double your admission today. Roman, can we do that? Can we double their admission for them?
Absolutely, but it's a free event, but go for it.
So make sure you double them, and everybody, you're going to be charged double. Roman's going to collect this doubling of 0. Okay. Okay. This is crude oil. Obviously bearish. Bearish because of recession. Watch. This market had a little buy off the low. Not much, not bullish. But we have to judge volume in the area. Market comes back down here. The volume kind of dries up. Not a bullish day. Not a bullish day, but not as bearish as you think. Wider range, less volume. Not a big deal. But I want to mark this because something is happening. Don't know what. It looks lower to me. It happened. I draw my line across. Look what happens here. Now, some people, the market should go higher. Look over here. Small range, increasing volume. For first results. Lack of demand. Boom. Also, next retest. This was a market. This is what I call bag holding to a great degree. Market had increasing volume, small range. It did not go lower. Someone was bag holding. I call it stuffing. Then they come up with the news with blah, 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 okay? This area, though not bullish per se in the sense of to get long because you're against trend, but you had to be out of shorts because this was bag holding to the market. Increasing volume, effort versus result. So that is really something, effort versus result is something I work on constantly with students because I think it's something that is one of the, because demand and supply can happen any time in the market. It depends on what happens, what's important. Effort versus result is the most important thing to me, effort result, and that cause and effect, that could be a 15-minute chart or it could be 10-year charts. So crude oil is stopping action, stuffing action here because of the volume relative to price. And I'm all done.
Gary,
I want to thank you. Thank you.
That was so great, and I just love your analysis. I love your thinking. And you just have to kind of adopt to Gary's ways of interpreting the market, of how he goes through the chart. And there is so much information, so many insights, into the tape reading. Gary, thank you so much. I also want to mention that you just did a tape reading class for us in January, so that is still available on our on-demand site. So, if you would like to see Gary's work, you could find it there, or ltgtrading.com, if I'm spelling it correctly, Gary. And I know that you have a bunch of stuff there.
Yeah, I'll just put up there for you guys. I mean, this is all about you guys and stuff, not about me really. And come here. I'll give you 2-week free to my newsletter and 1 hour free webinar. So just come to here if you want to come. As far as that goes, and more than welcome. I have to tell you, in the bottom of my heart, Roman asked a couple days ago, and he put together this thing. I don't know how he did it, but he put together great people, including himself and Bruce. I guess Bruce has to come with him, and David and Dr. Gary, one of the finest people in this industry. And to put it together and to get the amount of people that came to this thing, which is astronomical short term on a Friday, when people are, it's unbelievable tribute to you people that are here, because you are taking your time to learn a skill. And I think as we go more and more into this scary time, learning a skill of Wyckoff is the best investment that you guys will ever make in your life if you're interested in trading. There's no better than what is going on right now to learn Wyckoff. Because this is, even if you don't trade, to understand markets, Wyckoff style, with Bruce and Roman and everybody else here, to learn, you could pick your style, to learn these things. You are learning the best from the best of the best, but be more importantly, something you could never take away from is education.
Gary, thank you so much for these words. And, all of the speakers who are here, just really good people, and they just reacted so fast, and everybody was excited. So I'm just excited that we are having such a great event. And thank you for coming. Thank you for showing, your insights on the tape reading, on the markets. And surely we would love to see you in the future. Thank you, Gary.
I'd rather see you in the future than the past year. Okay, just a little joke. Not being underground. And seriously, everybody, please be safe, okay? And be very careful out there. Stay inside. Take Bruce's and Roman's classes, and take some of the people that are there. You cannot go wrong with any of that stuff.
Thank you, Gary, so much. All right. Well, we're gonna move on to our last presentation, and let me announce the speaker. This is a very special speaker. I consider David Wise, to be a teacher to so many students and to myself, including. His book, Trades About to Happen, is a mandatory requirement for our practicum class, which is the, where advanced students study. And with the permission of David, I've talked to him about that, and we are enjoying reading his book together in the classroom. I also consider David to be my mentor, and as Hank and as Bruce, people who I communicated a lot, David just has so much knowledge, so much experience, and I would just want to say this. If you want to study Wyckoff method and you haven't studied or read, material by David Wise, you have not studied the Wyckoff method. So with that, David, how are you doing today?
I'm doing all right. How are you, Roman?
Yes, I'm doing really well. We're at the end of the conference, but we are so excited to have you here. So with that, let me just give you the screen.
All right.
And we'll go from there.
Show my screen, right?
You have to, yeah, here we go. I see your screen.
You do?
Mm-hmm.
I'm looking for my charts then. Hold on. Let me start here. It's certainly a pleasure to be here, and I thank Roman and Bruce for inviting me to this. I enjoyed hearing everyone speak. I enjoyed that Russell 2000 chart that Gary Fuller just showed. I must say I didn't look at it enough. Unbelievable. I don't look at accumulation or distribution too much, but what I do look for is where to find trades. And in my book, this is the first chart in my book, and it's with the first chapter. It's called Where to Find Trades. And this is my mental model. We could be looking at a 1 minute chart, or we could be looking at a yearly chart. It doesn't matter. I'm looking for certain areas, upthrusts, springs, breakouts, tests of breakouts, breakdowns, tests of breakdowns. Those are the main areas on the chart. And you see there are smaller ones. When a market breaks down out of this little area, there's a test of that support, and down we go. When we break out of this area, we pull back and test that breakout. So this is something that goes on all the time. And it's my guide for where to find trades. Gary's let me make this chart bigger. Gary's presentation sort of dovetails mine. I'll make it a little bigger here. Hold on. It was great to hear Gary Dayton talk. He was very kind, talking about our sessions together and the tutoring and all. He was certainly, or is certainly, the best trader of anyone that I tutored with. He's done extremely well. I remember very fondly when we spoke for many sessions and going over chapter 7 in the Wyckoff course that I took in 1971. That's the one on the New York Times average of 50 stocks. It's one of Wyckoff's most brilliant pieces of writing. It's the longest chapter. And in there, it's not bar by bar, but it's pretty close to it. So let me get this thing set up right. I'm thinking about the trade that came up on the S&P on Tuesday. I wrote about it in my market letter on Tuesday night. As Gary mentioned, I do use this, and I developed this product called the Weiss Wave. The idea is that markets don't move in bundles of equal time, called 5-minute bars or 3-hour bars. They move in buying and selling waves. So if you can accumulate the volume on the various buying and selling waves, you can see changes in behavior that otherwise would go undetected. And so on this chart, what I've been doing in these more volatile times is I've been looking at bigger time frames, like the 4-hour and the 3-hour, and trying to find a story and then zeroing down to the 5-minute. Whereas it used to be, I started with the 5-minute. And you can still do that, but we usually have so much volatility that it's harder to get it in focus. But on Tuesday, the market rallied up to test Friday's high. And these are, as I say, the 3-hour bars, so I have plenty of time. I mean, this is like 4 in the morning Eastern time up here. But I get to think about this, and I notice these volumes are times 10,000 contracts. So this is 3.8 million contracts. This is 2.3 million, 3 million. This is a 1.54 million. So I see that the force of the buying is diminishing, and I see that we have barely made a new high overnight. We're in a minute upthrust position. And I look to the left and I see over here, when we came down the day before, we had 900,000 and 680,000 contracts. If you notice, those are the biggest downward volumes since Monday a week ago, at the low of the year, down here. So we encountered selling pressure over here on Monday, and then on Tuesday we come back up and tested and up-thrusted that high by just a hair. So that took my attention immediately. And I went over to focus on the 15-minute chart. This is the same position that morning at, I think it's around 12 o'clock in the morning, in the daytime. And what stands out on this chart? Gary Fullett mentioned effort versus reward. Look at what happened here. On this rally, we went up on 57,000 contracts. On this upward, we went up on 152,000 contracts. This upward right here is this little piece right in here. All right. This is 630,000, but here we have 152,000. We have another little upthrust. So there is obviously selling here, tremendous amount of effort. It's the biggest upward volume on this portion of the chart, and there's very little reward for the effort. So given the upthrust on the 3 hour, given the breakdown that we had, this was the morning opening on 151,000, and then we come up and just barely make a new high, and look at the 5-minute chart. This is just a little bit after noon. We've just started to turn down from this high right here. Look at this volume. Look at the story on this chart. We have a small upthrust right here. Just a tiny little upthrust, and we're starting down. This is the bar volume. This is the 5-minute volume. This is the wave volume. Look over here at how much selling we had on this downwave. You can't even tell how much selling we had from the 5-minute volume. It's lost in time. It's lost in the 5 minutes of each bar. It's like the tree line on the horizon when you're driving in a car across the country and you see the trees on the horizon, and nothing, very little stands out. There's very little definition, but there's great definition on the wave volume. You can see the morning break with heavy volume, and then the run up with a lot of buying, and then right here a change in behavior. And then here is that second upthrust, that little upthrust right here. Now look what happens next. We come down, and we go down on 333,000 contracts. And we rally up again on 87,000 and 71,000. Oh no, that's 700, that's 3.3 million and 870,000, 710,000. A lot of effort and no reward. On this chart, this is the 5-minute chart at the same spot. What tells you that the market is going to go down? Can anybody figure that out? What's the story on the 5-minute chart? Well, when you look at the 5-minute chart, the first thing I always do is draw a line through the level that you broke down through. Remember I said you want to test breakdowns or test breakouts. So we had a breakdown here with a lot of volume. We even had an increase in the bar volume on these 2 bars. And so we've come back to test that breakdown. I can't tell you what a great trading strategy this is. You can pull up bar charts, daily stock charts all day long, and you'll see this behavior. And then notice that here's the little upthrust of this high, right here. So we're just above it, not much buying anymore. And then there's one more clue. When you're reading charts, you don't just look at the wave volume or the bar volume, you also read the information of the individual price bars. So I'm always looking at, studying the range, the position of the close, and the volume of each bar. And I'm thinking about what stands out on each bar or each group of bars. And the question I would ask you is what stands out on the last 3 bars? Is there something that catches your eye? Is it the range, the position of the close, or the volume? It's certainly not the volume. Volume doesn't say, even the wave volume doesn't tell us much. It just shows no demand. But it's the closes. What do those closes show us? For 3 bars in a row, we close near the low. When you have price bars that close near the low, then you know we encountered selling. That doesn't mean we're going to always go down. What has to happen next is follow through. And sometimes we have follow through and sometimes we don't. But here we are in an upthrust position, testing this breakdown here. And look what we did. This is the 15-minute chart. That's where we were, and that's what we did into the close, and we went down the whole night as well. So, and this also is a test of that breakdown from overnight. This is, previous day's breakdown. Anyway, I'm always watching for testing of breakdowns or testing of breakouts. And look at today. Look at today's action. I just turned on the 5-minute chart before I put together some charts. And look what happened today. We had a high over here this morning at 8 in the morning, right before, I guess, the employment report. This is the employment report. These volumes are times 1,000. We moved laterally. We kept holding. A lot of bars closing together in here, suggesting we wanted to go up. So 1,000. What does that reflect? It's a potential up thrust, right? Not only is it a potential up thrust, look how much volume. 78,000 is great effort. And what did we get for it? What was the reward? And then we come down on 39,000, which is the heaviest downwave volume of the day. So we had huge effort to go up and the biggest amount of selling, and the next two up waves are a mere 16 and 17,000. That's the essence of what I do with the rice wave, is I look for a bearish change in behavior or a bullish change in behavior, followed by a low volume pullback. So this was a perfect place to enter trades, to go short, put your stop either above here or here. And you see, as I just made this chart since noon, but we've been making lower highs and lower lows ever since. Let's see, what did we do? So here's where we are. This is real time. That's where it was this morning when I printed the chart. And all we've done is make lower and lower lows and lower highs until right about here. Notice that we had 74,000 right here. That's more volume on the down wave for the whole day. So suddenly we have some idea that there might be some buying coming back into the market. What I would do next in real time is I would draw a trend line like so. I see that we've broken that trend line. I'd make it into a parallel and see what that tells me, if anything. So we were getting further and further away from the demand line of the channel. We were having a harder and harder time. In Wyckoff terms, that's called shortening of the thrust. And you can see that. And look, if you draw a horizontal line over here, you can see that this is a potential spring. This 74,000 has led to a rally on 32,000 and a pullback on more volume than we went up on, and we didn't make a new low. And now we've gone up on 43,000, which is the second heaviest upwave volume of the day. This doesn't guarantee that we're going up, but it's a mild change in behavior. We'll see how we handle it. To do any good today, to recover today, we've got to get back above this morning low over here at 8:30 that we had after the employment number. Let's look at the daily. Here's the daily chart. I mentioned in my stock market update report last night. Last time we had a jobless claims was this day. The number was 3.3 million new claims. We went up 220 points from the low to the high. We had claims yesterday, 6.6 million, twice as much. We went 100 points up from the low to the intraday high. So neither one of these reports had any bearing on the market, didn't have any bearish effect on the market. Now what have we got today? We've got a little Looks, I think it's a slight upthrust, as we saw earlier, of yesterday's high, but mostly it's an inside day on low volume. So it's not terribly threatening. But we're unable to rally away from the danger point here in these 2 days, away from Monday's low. So we're still vulnerable to going lower. Look at this line over here. I drew this support. See how we broke through it, rallied up to it. Broke through it, rallied up to it. So I'm always watching for tests of these breakdowns. It's a great strategy for finding trades. Anyway, I've shown you a lot of little things that I look at. I could go on all day, but I'd have to get all those charts out. And I didn't have time to do that. So if you have questions or anything you want to ask me, let me know.
Sure. And at this point, let's entertain some questions for David. David, there are a couple of questions that already came in. Actually, more than that. A question from Eric. What are the numbers on Mr. Wise's charts?
These numbers are, I should have said that, I suppose. Thanks, Eric. This is the cumulative volume in thousands. Like this is 67,000, this is 43,000. So I'm adding up the volume of every 5-minute bar until there is a 75 tick reversal. Three ticks are 0.75 points. In other words, if the market closes a 5-minute bar at 24.90, it's got to close at 24.89 1/4 to turn down. As long as it keeps going to 90 or higher, I keep adding the volume. It's like a point and figure chart, but it's got volume on the waves.
David,
What's next?
next question. Can we use Wise Wave for Forex trading where it's hard to get volume from Chakra?
You use tick volume. Here, I'll show you. Let's do EUR USD.
And kind of like a follow-up question, David, to that on tick for the tick charts. Do you find much difference using the wave volume on tick charts versus time charts?
There's no difference. The only thing that's different, you know, until about 1988 or 1992 or 95, I don't remember what year it was, all we had in futures was tick volume. We didn't have actual volume intraday. So if I want to put tick volume on this chart, first thing I have to do in TradeStation is tell it that I'm not going to use trade volume, I'm going to use tick count. Every platform has its own method. So then I can put the Rice wave on this chart. TradeStation doesn't do Forex trading anymore, so I don't trust its data. So I usually use a 4-pip retrace. In TradeStation, that's 0004. And the volumes are put in 100 ticks, units of 100 ticks. So this is 2100 ticks. This is 200 ticks. This doesn't tell us too much. I'd rather put it times 10. The numbers would be better, more readable. So to do that, you're going to now be multiplied by 10 instead of 100. So you can see this morning, just in this portion of the chart, you draw a line, you see you had a spring right here of that level. And after that spring, you went up on 1,030 ticks. And now we're going to test the spring. And we come down on 400, and lo and behold, we come down on 170. And what does that say about the force of the selling? It's dried up. There is no more selling. And where would you buy it? You buy it on this outside upward reversal bar and put a stop right under that low and say, prove me wrong, circuit.
David,
And look at the downtrend line. Look at the story on this chart. It's a beautiful little story. Look at it. Look how we coiled into that apex there. Oh, nice. What else?
David, so still related to the WiseWave, so which softwares does it work on? And
It works on NinjaTrader 7 and 8, works on TradeStation, MT4, and Metastock.
all right, and does it work for Bitcoins?
Yeah, I mean, I don't know. I don't have Bitcoin data. I don't. I just have the futures, but I don't know. I don't know about actual Bitcoins. I've never traded them. But let me see. The futures. What's the symbol? BTCM20. I'm just guessing. Probably wrong. Yeah, it's probably just BT. B. It's a great chart. I mean, it doesn't have a lot of volume, but I
David,
can't see. Maybe it's BTC. Hold on. No, I did that. I can't find it. Anyway, what else?
um, is there a tutorial on how to put parameters into the WISE indicator from Mahmoud?
Well, I show everybody who buys it if they want. If they have questions, I can help them. I have a 20-page trade setup style. It comes for buyers. It shows the setups that I'm looking for, but it's usually a function of the scale. You know, I mean, if you bring up a chart, um, let's look at Microsoft. It's always fun. Now, if you want to make I did that wrong. All right. We've got a dollar scale on this chart. So we're not going to make a dollar way wrong. Because if we do that, we're going to have one wave up and one wave down. So, because there are no dollar fluctuations in here, or hardly any. So we've got to find something within a dollar. So I usually start at 10 cents for most stocks. It's not very hard. You get the feel of it pretty quickly. So let's do 10 cents.
David,
And let's do 100,000, right?
while you're doing this, can I ask you another question? Could I ask you next question?
Yeah,
From Pat, I've noted that you use WiseWave on hourly and dailies. Is WiseWave instructing on longer term, weeklies and monthlies?
absolutely. You can use it on any chart with volume. You can use it on Renko. You can use it on point and figure. You can use it on tick bar charts. But we did that with Forex. That was tick bar volume, but we can do it on tick bar charts too.
David, another interesting question.
Microsoft today. What?
Go ahead, go ahead.
What's your question?
Yeah, just an interesting question about Wyckoff, Richard D. Wyckoff himself. From Mario, did Wyckoff himself trade the intraday charts?
Absolutely. Let me show you what he traded. Well, let's see. This is what he traded. This is called a tape reading chart. This is AT&T, June 2nd, 1932. It's a 1/8 by 1/8 point and figure. You know, stocks traded in eighths in 1932. And so these volumes are in hundreds of shares. And this is what Gary Dayton and I worked on together. This is a beautiful chart. If you take the time, look here. It's coming down. Look at this change in behavior right here. 1,700 shares on that uptick. That's more volume on any uptick on this chart up to that point. This is a 1-to-1 ratio point and figure plotted as a tape reading chart.
Amazing. I'm seeing a lot of like up movements here on this chart, David, like with climactic volume like 1,600 right there.
Yeah. Well,
Into the end
look
of the
what I did. is I took this chart. How do I change the page on this thing? If I can just go to the next page. Hold on. I don't know how to do it. It's in the way. I don't know how to. I can show you how I modified it. This is a 1/8 by 1/8. I made it into a 1 by 3. And I totaled the volume on each column. So like right in here, look how much volume is on this up wave if you added up all those numbers. But then
That,
look how much volume is on this up wave. This up wave probably has more volume than this up wave, shortening of the thrust and effort versus reward.
yeah, I like that 16 at the end on the big spike up, and then the next smaller wave up.
Yeah, that's the biggest volume on an uptick since way over here where we broke out. Yeah, it's a great chart.
Yeah, kind of, you feel the presence of the man himself here on this
Yeah,
chart.
you do. You do.
Kind of like a comment directed at me, why Ramon doesn't teach this, meaning, David Wise Wave. It's much easier than reading volume. So, David, I'm going to send all of the students to you now. So please tell us, how do people actually, purchase this from you, this indicator, David Wise Wave?
Well, if you want to purchase the one from TradeStation, you can do it on my website, Wyckoff.com. If you want to buy NinjaTrader 8 or Metastock or MT4, you just send me a note and I'll send you a PayPal invoice for $500. And then once I get the payment, I'll send you the software, the loading instructions, the trade setups file, and so on.
All right. Well, David, I don't see, I still see some questions coming in. I don't know if you have more time.
I'm all right.
Okay. Well, there are still some questions on the Wise Wave, and I think that we've covered this. How do you determine what settings to use for your Wise Wave? And I think maybe it's related to the time frame. How
Well,
would
it's
you answer
related
that?
also to the scale of the chart.
Mhm.
You know, if I bring up the monthly chart, this is the daily. Now, first of all, I got to change the numbers. These numbers were in hundreds of thousands, scaled in 100,000. So I'm going to do 10 million. Let's see if that helps. That helps a little bit. And then spread it out a little. It's, this is still a 10-cent wave, but it works all right on a monthly chart. You could get more waves, but you might just get too much noise. But look, I mean, you went up on, I don't know how many millions that is. What is that times 10 million? It's 151 million? I don't know. Anyway, we came down on 93 and 94, and we have a little spring right there. And up we go again on 221, down on only 55, and then engulfing up outside upward reversal. Anyway, you could probably do a little better with the way you retrace on it. You might make it a little bigger. Maybe make it 25 cents. But anyway, doesn't take long to figure that out.
David, could we ask you to give us your perspective a little bit on the current market? Maybe on a higher time frame, like daily, weekly. What do you see there?
Well, let's see there. I'm pretty bearish. I think the
And by the way,
range.
I just want to commend you on calling the bear market on the first leg down. I just remember just looking at your research at your report, and you said this is a bear market, and that was such a brilliant call.
Thank you. I don't remember being so perfect. I did know I had a point and figure target of 34.20. We went to 33.97 in futures. And I knew that we were inching up here and that, this wasn't going to last. without some kind of serious washout, at least. So, you know, but I'm mostly a day trader in the S&P, sometimes 2 days. I used to trade swing trades a long time ago in the S&P, as I told somebody. Yeah, but anyway, I don't do it anymore. I do swing trade in some of the commodities, like corn and sugar and soybean meal and so on. But no, I think it's pretty bearish, and I think it's going to take several years. I mean, I'm not convinced we're going to make new highs.
For some time. And this most recent activity, you know, this most recent price activity, how would you interpret this rise into that 27.15? Do you see, you know, that demand is actually, you know, active, or is it complacent? How do you interpret that? And what are the important levels for you? If you're still bearish, you know, what are you looking at?
Well, just think of it. First of all, think about this. Last week's rally from this low to this high is bigger than the rally from last October to January of this year. You believe that? 4 months.
Mm-hmm.
This is bigger than. So that's a massive rally. I'm not sure we're going to see a 50% pullback anytime soon. 50% would be about 27.85 on futures. I can see us getting up to 27.15. But I think this is just the beginning of a larger downwave. I could certainly, my target on the downside, my first target was 21.34. We went to 21.47, or maybe it was 21.23, I forget. I think it was 34. But it went 21.74. And I saw the turn here on that Monday, when we had a lot of effort, no reward on a secondary test of that low. But I was talking to a friend yesterday, and we were talking about how many years it took to come back from the 2000 high to the 2007 high. It took 7 years. From 2007, it took almost 5 years to get back to 2007 and 2012. I think those are the numbers. Anyway, once you're going to take, you know, I hear people say we're going to be back to this year's high in 2 years. I'm very skeptical of that.
Mm-hmm.
I just don't see it.
As we look at this daily chart, there are a couple of questions on Elliott wave, and I know that you're in-heart Elliottician. You know, it's ingrained in you. So
It was the first thing I read.
yes.
First thing I read was the 12 Financial World articles.
So
the Hamilton Bolton's book, Elliott Wave Principle of Critical Appraisal.
The question that we have from Michael and from Robert, do you incorporate Elliott wave in any way? And the second one is, are we in wave 4 going down to wave 5?
No, I do incorporate Elliott wave, even if I don't want to. I always say I have an affliction called Elliott eyes. I wrote a book about trading with the Elliott wave principle. I worked with Bob Proctor for 2 or 3 years. So, you know, once you learn it, you can't forget it. I know its weaknesses and I know its strengths, and I know it's very fascinating. I think we've done a 5-wave move down from the February high, and we're in some kind of a correction, and we might get an upthrust above this high yet to test the 27.15 maybe, but I think from there we're going lower. This is just the first wave down.
David, Robert is continue asking about Elliott wave. Is there any books that you would recommend, or are there any books on your website about the Elliott wave?
None on my website. Of course, I think Proctor is the Bible. He and A.J. Frost put the book together. And I like Hamilton Bolton's, it was the first book on Elliott Wave, A Critical Appraisal. And he made a comment in that book that I never forgot. And he said, it's best that you have a higher probability of getting wave counts correct if you don't go too far away from the starting point of your count. In other words, I can count from 2009, but if I'm going to try to put this all into a souffle from 1932, what are my odds of being right? That's a different story. So I don't like to go I used to like to go the real long term, and I built long-term futures charts going back centuries on commodities, wheat and corn, and anyway. But I don't pay much attention to that anymore.
David, speaking of wheat and corn and commodities in general, Franz is asking, are commodities bearish right now or not? Could you show us maybe?
It looks like everything's cracked. I mean, except gold. I mean, I'm looking at silver. I watch SLV. Look at this chart of SLV. You know, the ETF for silver. This is a point and figure with volume. This is the high in August or September of last year. And I think there's still more coming on the downside in silver. And I was looking at some long-term cycles in silver and sugar and several others. And it calls for lows in a couple of years in a whole range of commodities. So that might happen. You know, commodities usually peak first and bottom first before equities. So that might happen this time. I don't know.
David, you mentioned to me a book on cycles that you recommended. Could you tell our audience what that book is?
It's at the time I couldn't remember the author, and I still can't. What is it? The Mysterious Forces That Trigger Events. That's the name of the book. It's paperback. What's the author? You remember?
Mm-hmm. I don't have it in front of me, but yeah, I have it in my library.
He was the one who founded the Foundation for the Study of Cycles. It's a great book for anyone interested in cycles. I can't think of his name. I never do.
David, could we quickly look at oil if we still have a little bit of time?
Sure. I was looking at it a little while ago. It's one of my favorite charts. Look at this monthly chart of crude oil. This is the essence of what I like to see. In other words, here was the breakdown area right here where the volume jumped, the ranges expanded, and I knew when we got down to this low, we were going to get, there's a 1, 2, 3, 4, 5 down. We were going to get a rally back to test that downtrend line, to test the breakdown line, and to test the top of the up channel. So that was a wonderful play, and you had a little up thrust and downward reversal there. That was really a no-brainer. And then the downward reversal a few months ago set the stage for this breakdown. I would imagine we can hold here for a while and maybe shorten the thrust and end this thing. I find it hard to believe that we're going to $8. You know, crude oil was 25 cents in 1932. I don't think we're going down there again either. But I'm watching this still, and this is one that I've traded on a longer term basis.
Can we look at the daily chart and what's your view there?
This is a continuation. Here's the daily. Oops. That's the hourly.
And by the way, David, so you know, people have found the book, The Mysterious Forces That Trigger Events by Edward Dewey.
Edward Dewey, right.
Mm.
Yeah, it's a great book. It's a great book if you're interested in cycles. It teaches you how to detrend data into sine waves. It's very good.
So what do you
But
see here on the daily?
well, you know, my Elliott wave eyes see a 1-2 and a 1-2, 3, 4, maybe 5. So maybe we finish 3 waves down. We got a spring right here. We're getting some pretty good volume here off this liftoff. I think we have a chance to get up. Certainly, you know, the first target, we've already gotten to the first target. It would be this low. Remember, markets come back to test breakdown areas. So we're closing above that breakdown area this week. It's very good. Or today, we are, and this week. So the next area would be somewhere into here that we could rebound to. I think we'll have a hard time. Let's put the weekly up. I think we'll have a hard time getting back above that low.
Mm-hmm.
But we could test it. This is that axis line. See, it was lows over here in 2016.
So some kind of rally from the oversold, you know, more
Yeah,
of the technical nature, and then just seeing if supply is going to come between 35 and
yeah,
40.
right.
Another question, again, if you still have time, what are your views on gold?
Well, that's a good question. Let's take a look. Hold on. I've been looking at it. You know, I had this theory, or this fear, let's put it that way, that all of this stimulation is going to produce some kind of hyperinflation.
Mm-hmm.
I hope not. It's a good way for the government to pay off its debt, is to make the dollars become worthless. That's what happened in Germany in the 1920s. My grandfather was in Germany at that time, and his brother was older and remembered when his father told him to go pay off the mortgage with a big box of money. Is this gold? Yeah, this is the gold monthly. I mean, you have to be impressed that gold is the one commodity that is really doing well. Look at this line over here. This is where we had the biggest volume in 2015, 2013, right here. And we broke through. And we always rallied up into the lower part of that range, but we never got above it until last year. And we're holding above it. So I wonder if it couldn't still go higher.
Would you see that rally into 1700 as a major sign of strength out of this big cause, and maybe this volatility that came just recently as the start of the backing up action and a trading range?
It could be. It could be. I'm not sure, but I mean, I know this break that we had over here, it looks like we changed contracts from April to June right here. I don't have a cash gold chart handy. It doesn't have that distortion in it, but anyway, it could be.
Just to quick,
I fear the hyperinflation because if you're holding cash, it's going to be worthless.
just to come back really quickly to oil, and we don't have to go to the chart. The question is, what are the probabilities of going below 20? You know, on the rumors that.
I think it's pretty slim. We might poke under it a little bit, but I don't think they're going to let it go under it very much.
All right. All right. Well, David, thank you so much. There are so many great comments about your presentation, and you know, the community and people are so thankful and grateful that you
Pleasure.
joined us.
I always enjoy this.
Yeah, and I'm just really really appreciative that you found the time, and
Well, I didn't have time to really put something together on it.
mhm.
I just put two recent charts together. But, anyway,
All right.
y'all
Well,
have a nice weekend.
David, thank you so
Stay
much.
safe.
Stay safe, and thank you.
All right, take care.
All right, guys. Well, this is it. This is our conference, as you could see, and speakers attested to this. Obviously, we didn't have a lot of time to prepare. That was more of the improvised conference. I was thinking yesterday that this is the best of Wyckoff, the event that you usually have in August, September, and it was just amazing. I got so much information from all of the speakers, all of the 4 speakers that I listened to, and what a variety of ideas, what a variety and depth of knowledge and skill. And I thought tape reading today was just like so on the table. So many conversations about that. I really loved all of the big analogs, and just thinking about how the structure could be created, and what might happen next. So, and it's just my pleasure and the pleasure of all of the speakers just to be with you on this Friday, when we're in the lockdown or whatever you guys do. Thank you for being such an integral part of our community, of the Wyckoff Nation. We really, really appreciate this. I must say that Wyckoff Nation has so much talent, and I'm looking at a lot of you as you give us your work, as you send us your work. Please do so. Please send it to us. We have the platform to bring you in and to uh, share your knowledge with other students. And it's extremely important to do that, because in a lot of cases, when you see other students present their thoughts, their ideas, their interpretation, it might be different from how we, teachers are giving that material to you. So please don't shy away. Don't think about your mistakes. We're all students of the market. And with that, I just want to conclude, a big thank you to all of the speakers to come on a such short notice, to pull together such wonderful presentations, to answer all of our questions. Really, really appreciative to all of you. This session has been recorded, and we will be working with the video for some time. Hopefully by the evening tonight, we will post it on Wyckoff Trading Method, our YouTube channel. We will distribute this to all of the speakers so that they will be able to distribute it to all of their members. We will also send it out in our newsletter, on Twitter, so you could definitely find that information and watch the recording again. If you had some audio problems, and I know that some people did, apologies. This usually is related to some connection problems, so hopefully the video will remedy this. If you have any questions or comments, please email us at wyckofassociates@gmail.com. And with that, thank you so much. Stay safe, and let's be together. Come to us. Let's talk Wyckoff and the markets. Thank you, guys, and bye-bye.